Roll call, Trustee Faulkner, Vice Chair Faulkner.
Here.
Trustee Abbott.
Here.
Trustee Chandra.
Here.
Trustee Chi.
Here.
Trustee Linder.
Here.
Trustee Nakagawa.
Here.
And the chair is here, and we can vote by raising our hands, since we are all here. Thank you. Orders of the day, we have a time certain item at 10 a.m., and we will endeavor to take a break just prior to that. And we may need to flexibly reorder some things as one of our presenters is running a little bit late from Akita. So with that, we will at this time, we will take public comment, general public comment by members of the public for items that are not included on the agenda, but that are within the subject matter jurisdiction of this board. Are there any public commenters present or online? There are none.
Nope. I see a hand.
Sorry? I saw no comment from... Oh, there is? Okay.
Excuse me, my hand's up.
Okay, but forgive me, I did not, there was a bit of a delay here with the recognition. So public commenters will have, I believe, 2 minutes now for public comment on general comments, so please proceed.
Thank you, Mr. Chair. Good morning, trustees and staff present. I assume maybe there's no beneficiaries present, I don't know. Anyway, I'd like to maybe follow up on a comment I made on last month regarding the use of AI. I'd like to see a real serious discussion, maybe including beneficiaries and stakeholders with regard to the use of AI and its current use, actually. I'd like to know, what your consultants are and to what extent they're using AI. And I see with the update of the member portal that we're now going to get our pension information online only. So we're not going to be able to speak to humans, so to speak. Maybe the CEO, Mr. Flynn, could clarify on that. Also, I noticed that you still can't update your withholding information or application online. That doesn't seem to, that since we're the capital of Silicon Valley, I can't understand why we have to send in print out a paper WP and send it in. So anyway, I would hope that, again, going forward, we can have a discussion on how that's going to affect the staff in terms of the use of AI and remote working. And I'm just curious as to what the investment analysts are doing on a day-to-day basis when we have a lot of use of AI. I don't know if the staffing is going to be affected on that. So if you can please let me know. Thank you.
Okay, thank you. We will be discussing AI. It's not on today's agenda, but there will be a comprehensive look at that as well. And as far as the member portal, that is currently under review and being improved. So we will be addressing that, I believe, later today with the strategic plan. Please.
Just one comment. So the office hours staying the same, both for in-person and for telephone support for all of our members. So regardless of the enhancements that we're planning to our website, our member direct portal, there is no reduction in the ability for somebody who wants to communicate with us verbally or come in person. We're there to support the membership, how they want to be engaged.
Okay, great. Thank you for confirming that. Okay, are there any other public commenters?
Excuse me, can I quickly comment on something?
I'm sorry, we have one public comment per commenter, and we have to maintain our rules in order to maintain the flow of the agenda. So you will have a chance, of course, to comment on agenda items assuming it is relevant to the agenda item. So if there are no other public commenters, we will move to the consent calendar. Do we have anyone wishing to pull anything from consent calendar? And if not, I will entertain a motion to approve.
So moved, Mr. Chair.
Thank you. We have a motion from trustee Linder, a second.
I'll second.
I have, trustee Nakagawa beat you to the punch. Any public discussion? Any trustee discussion? If not, we can vote by raising our hands. All in favor? Opposed? None? It passes. Very good, thank you. Agenda item number 2, which is death and survivorship. Please join me in a moment of silence for those who have served the city and who have passed. Thank you. Agenda item 3A, oral update from our CIO, Mr. Kwan.
Good morning, and thank you, Chair. So I had a chance last week to speak with the Retired Employees Association. It was great to check in with some of our most important stakeholders. And, you know, when we go through on the agenda of these board meetings, we go through the death and survivorship notifications. I have to remind myself that each of those lines is a lifetime with potentially decades of city service. So spending time at events like the association luncheon is a great opportunity to add a lot of color, and it's a great reminder that it's a great reminder to me that we're actually serving people and not just a stream of pension liabilities. And so I do appreciate the invitation. Thank you so much. They did have some tough questions, though, as expected. So a lot of their questions were around the performance of the plan, of course, and I'm happy to report that the estimates provided by Makita as of Tuesday, the 16th, for the pension, are fiscal year to date 14.7%, and healthcare trust 18.2%. Now, as always, I'll caveat the precision of those estimates, but I will note that those are a very healthy margin above the 6 5/8 discount rate. So if you play with the calculators that Chiron distributed access to, you'll see if you plug in those returns, then on a market value basis, the pension is forecasted to be funded at a rate above 70%. Which, if you've been around on the board for a while, that's amazing. So
I assume that's on market valuation?
Yes,
Okay.
on a market value basis. So that, again, very strong improvement over a long period of time, but I think, you know, the bill would give appropriate attribution to all the parties involved, including the sponsor for the stream of payments following the funding policy, as well as, of course, yourselves in setting that policy. So that's all to say that this is a great time to re-underwrite this plan's ability and willingness to take risk. And we're going to do that through a formal process of conducting an asset liability study. So I'm not sure the last time we've conducted that at a board level. We've done pieces of that, most recently this spring, where we updated the current asset allocation with the current, at the time, risk and return estimates. So that's a part of the asset liability study. But every 3 to 5 years or so, we should be going through this full study where we marry the assumptions from Chiron with the strategic asset allocation that we'll recommend. And so we're going to go through that process at the next board meeting in August. So I'm just going to tee up a little bit of a schedule here. When you return on August 20th for the board meeting, we'll have Chiron and Makita present the asset liability study. That's mostly going to be Makita doing the front-facing stuff, but Chiron will have, again, given all of the inputs into creating that liability stream. At the end of that meeting, so at the end of the August board meeting, we'll hopefully present you all with at least a couple different strategic asset allocation options for consideration. won't ask for a vote at the meeting because shortly thereafter, on the 25th, we're going to have an IC meeting. And, you know, the IC is going to talk it to death. We'll have an in-depth discussion of each of those items with the goal of hopefully coalescing around one of the strategic asset allocation recommendations that you can turn around and recommend back to the full board. And so we'd like to come out of that August IC meeting with a recommended allocation for the full board's consideration in September. So we're going to have 2 board meetings and an IC meeting sandwiched in between to discuss a new strategic asset allocation. Back to today's meeting, we've got our standard set of quarterly reports from Neuberger and Makita, as well as a resolution to revise the IPS to reflect the change to that multi-sector bonds allocation that we discussed last meeting. We're just going to formalize that. Before we get to that, I wanted to give Christina a couple minutes here to run through an update on the public equity portfolio. So she's just going to talk about a few of the redemptions that we've done, and she'll give you a short summary of the movement within the allocation.
Jay,
Yes.
I have a question. When I looked at the Makita stuff, they said that our fiscal year to date, we were 6% for the report that they're doing. And you just said that we were at 14.7% year to date. Is there a difference in timing or?
Yes. So the reports on the agenda today show the returns through the end of March. So
Yeah.
at the very least, there's a timing issue. The estimates I gave from Makita run through, what did I say, the 16th of June.
Yeah.
So there's an extra
Okay.
last.
So there's been a big increase in the last 3 months. then.
Yeah, I'll check on the numbers you have. I don't think it was 6% through
Yeah,
March.
Yep.
I wrote it down. So, and it was, and we were 11.5% at your update last time, and so I was looking at this and going, oh, that seems like a big difference.
Okay, I'll follow
So-
up with you on that.
Yeah, it'd be great.
Yeah, just added, just to in response to your question, quarter to date since March, I was looking at my screens until June 16. ACWI, the global index, is up 15.8%, and especially strong is emerging markets,
Yeah.
up about 28%. And assuming our plan has a decent allocation to emerging markets, so that was the driver behind the strong
Thank you.
return in Q2. Thanks, Jay. I want to provide some updates on our public equity portfolio. We have some activities in this portfolio in Q2. Specifically, we terminated our 2 global managers, Artisan Global Value and Artisan Global Opportunities. So the termination was driven by a few factors. One is persistent underperformance in the growth space of our manager, and also lack of exposure to the high growth areas. That's the driver behind the underperformance. And secondly, the value and growth blend historically have worked well and being complementary to each other. However, global equity in general has been a very difficult space. According to an RVK study, 26 of large cap growth managers underperform their benchmark over time. So it's very difficult for active managers in the global space in general. And 3, our asset allocation, just to remind the team, we have about 12% allocated to emerging markets, 12% in international, and 25% in the US. A global manager really can go into emerging markets, international, and US, but we have regional targets. And historically, they have been deviating from these regional or sector allocation from the index, which creates a lot of underweights in the US, for example, and in infotech sector, and is an unwanted risk that persists in our portfolio. So we want to correct that. And also, related to the re-underwriting of our underperforming managers, we looked at alternative solutions. For example, shall we replace our global growth with another global growth manager, or have a core manager which can be more nimble in their positioning? However, both approach was not successful in this period. So we decided to exit the global managers. And we also made some changes in our international strategy. We terminated two large cap international strategies and also hired a new international core strategy. One of the strategy is a value strategy, which have done very well against the core benchmark. However, it lacked its core value peers. And also another growth manager has performance challenges because of their style. However, we think there will be better replacement for this manager. So we decided to exit both strategies. And we gave an update on managers on watch list during our last IC meeting. Unfortunately, we are still getting, as we get into this late market cycle, we're still seeing managers struggle, which we discussed in the IC. The reason for their underperformance are more related to their style rather than stock selection. For example, according to a discussion with Alpine Macro, a momentum versus minimum volatility relative return is now at a 5 sigma event. So momentum managers or stocks just based on pure momentum has done extremely well relative to some lower beta, lower vol, high quality types of stocks, which some of our managers really like these type of stocks like Burgundy. They struggled in this environment. We spoke to the team internally and also with the manager. And our current recommendation is a hold. We will watch the manager closely and continuously test our thesis. And to my earlier point, emerging markets this year has done extremely well, and our plan has benefited from the strong performance. However, it's an extremely narrow market. It's driven by basically 3 stocks, TSMC, Samsung, and SK Hynix. And the 3 stocks is now 27% of the index. And especially Infotech in the index has exceeded 40%. It's surpassing the previous high of close to 30% in 2018. And year to date, just to give a sense of how this performance dispersion is present in the emerging markets, emerging markets Infotech returned year to date 93%. However, the rest of MSCI EMX Asia Tech returned only negative 6.5%. So this huge dispersion and concentration has created some headwinds for our active managers. Therefore, we will see some underperformance from these managers. We're very closely monitoring our managers, engaging active conversations with them, and may consider reposition the portfolio. Some other areas that I also want to mention is we have 2 dedicated managers in India, and India is now less than 60%, is about 1% of our total portfolio. It's a long-term and strategic allocation. However, it is facing some short-term headwinds. Despite their lacked performance, we still believe there is fundamentals, and it has largely held up. So Taiwan and Korea are more currently benefiting from this very concentrated tech cycle. However, we think India's thesis is much broader and more internally driven. So looking at a very long-term horizon, we believe India's growth is much more durable and diversified in the emerging market space. So we're now holding on to our India allocation. But again, as we retest our thesis and continuously monitor our managers, we might make changes. And so in response to the current environment, a very strong return in the absolute value. However, we see some challenges in our managers. We have intensified our oversight of external managers. Our engagement framework includes quarterly performance reviews with the managers, ad hoc discussions with portfolio managers, and targeted inquiries into relative positioning, and more importantly, their forward-looking investment thesis. To ensure a robust decision-making process, we're synthesizing independent analysis from Makita in terms of manager monitoring on their research report on managers, their on-site notes with the managers, and also talk to Virus on our risk positioning, how to allocate to active managers and sizing and their contribution to our tracking error. and also talking to Neuberger Berman with their portfolio analytics tools. And also peer plans, like other retirement plans, when they look at their active managers, what their experiences are, and also their observations. So we're actively engaging with multiple parties, internally, externally, and so this multidimensional approach, and alongside with the changes we have made to the portfolio, ensures that every decision regarding our manager lineup is data-driven, not driven by sentiment, and also more long-term, aligned with the long-term strategic objective of the plan. So yeah, happy to take any questions, but this is a brief update on our current public equity portfolio.
Great. Thank you so much for bringing that to the full board. Are there any questions from trustees? I have a question. Maybe it's just my perception. It seems we have maybe more aggressively axed managers in this previous quarter or this previous month from the past. Is that a correct perception, or?
I could see how you would come to that conclusion.
Okay.
I would stress, and this is I think what we in part tried to do with this update, is to present or make it clear that there's a process, an ongoing process of continuous evaluation of the managers. Some of these names have been on the watch list for a prolonged amount of time.
Mm-hmm.
And so, I was expecting questions from a couple different perspectives from you all of why is it taking this long, or as opposed to,
Well, I'm not objecting to the fact. I'm just trying to confirm that my perception is accurate.
Yeah, you are correct. It has
Okay.
been a while since there's been a redemption.
Okay.
And it just, I think, happened to line up here with the end of the fiscal year, new CIO coming on board. You can write that narrative, I think, from a couple different perspectives. But I wanted to reassure you all that there's and hopefully you got that from Christina's comments, that there's a ongoing monitoring process. Things hit the watch list. Even before things hit the watch list, there's a heightened period of review. There's a lot of scrutiny that happens on a standard basis, right? And then when things with managers go in a direction that aren't meeting expectations, that level of scrutiny ratchets up. Eventually, it gets to a point where, hey, there's been enough rope. Now it's time to cut it. So,
Would you say that there has been a shift in the algorithm or procedures by which we choose to terminate managers? Are we tightening up the criteria? Are we less tolerant of underperformance over longer periods? Has something changed?
no, I don't think anything's changed from that perspective. We've taken great pains to re-underwrite each investment officer's process and kind of due diligence philosophy. Their process and philosophy hasn't changed. Mine has been consistent throughout time here as well. To be honest, I'm very loath to have manager turnover in the lineup. I am a firm believer in aligning our expectations of the strategies with our very long time horizon. Things move in cycles, and when we underwrite a strategy to a certain set of expectations, sometimes it's the expectations that don't come to fruition, and not necessarily the manager's approach, right? That the market environment could be not right for that strategy. And then you have to question whether, how patient you can be with a strategy. Is the market environment going to turn, or are you, forced to readjust your positioning? Of course, if something happens at the strategy level with PM turnover or some kind of news related to the firm, then changes might be more exigent. So it's.
I'm hearing crosstalk. Are there people?
Are you not able to mute?
Ms. Morrison is actually muted, as well as there's no video. However, they're able to, and that's what we're trying to figure out right now.
Okay.
But we can't kick them out, so.
Is it possible to turn the volume down?
But the volume is down. I will ask the.
Okay.
Thank you.
All right, thank you. I'm sorry, go ahead, Mr. Kwan.
Yeah, I'll wrap it up, actually. Long story short, nothing's changed in terms of process and philosophy, but that the process has been robust this entire time.
Okay. Any other questions on this aspect of the investment management teams? I would like to, before I close out this agenda item, return to your previous comments about what we have coming down the pike immediately, which is the asset liability study. And I was just wondering if you could describe for us, so we can set, thank you so much, by the way. If you can describe in a sentence or two how that is different than the normal process we see with the strategic asset allocation review annually. Is this more expansive, more robust? What's different this time?
All of those adjectives. So it normally, and it was normal would be just a couple of months ago where we had our existing asset allocation. We didn't present alternatives to that. We just updated our existing asset allocation for current at the time risk and return estimates. This go around at the end of the asset allocation, asset liability study, we'll be presenting you with a couple different alternatives for the asset allocation. So we'll have the current and then at least one alternative there. I fully intend to make a staff recommendation for one of those. Alongside both of those options, there will be a whole suite of scenario and I think it's called economic regime modeling from Makita. And so they'll talk about how those alternatives perform in different scenarios. We'll be able to consider what the liability stream looks like based on the information from Chiron. We'll be able to consider what the employee and sponsor contribution path looks like, and for at least the next 3 to 5 years until we can do this asset liability study again. So it's I would just characterize it as more of a comprehensive process than we normally conduct in the spring.
Okay, so different in degree and not necessarily in
the outcome
subject.
Outcome. I guess functionally the outcome is the same. You're choosing an asset allocation. In the spring, we're just kind of updating, refreshing, right? This is your chance to change the direction or risk level of the plan, should you so desire.
Okay. Any other questions from trustees on the CIO update? Any?
I have one, actually.
Okay.
So you mentioned the 14.7% on the pension. Do you know what the benchmark is?
Yeah, so again, both estimates here. The pension return estimate was 14.7. The policy benchmark return was 16.3.
And what do you attribute that difference to?
Well, we walked through a lot of it, I think, in the at the presentation of the year-end performance in the March meeting. And so there's a lot of tracking error coming from the public equity portfolio. You've just heard Christina talk about some of our efforts to remediate the tracking error there. I don't want to walk through everything she said, but it's a very concentrated market. You're holding active strategies. If you were ever going to get tracking error, it'd be in a situation like this.
Okay. Any other trustee questions? Ms. Linder?
No question. I just want to let the board know that Jay did a very nice job with our San Jose Retired Employees Association. Yes, there were a lot of good questions, but he did well, and they're happy to have him there.
Great. That's reassuring to hear. And it is reassuring to hear that our absolute return is 14.7 fiscal year to date.
Yeah.
You've got 2 weeks.
We'll see what the bubble brings.
Don't mess it up.
It's not jinx
If there are no other trustee questions, I will ask for public comment on this agenda item. Is there any?
Yes.
There is public comment. Again, the public commenters will have 2 minutes to address this agenda item. Please unmute the speaker. Public commenter, are you there?
Yeah, apparently this is not working.
Okay.
We have two. One is Brad Imamura, and the
Mhm.
second one is Mark Washington.
Okay.
Mr.
And,
Imamura, you have 2 minutes. Oh, he dropped off. My apologies.
okay, then, was that Mr. Washington?
Yes.
Mr. Washington, you have 2 minutes to address this agenda item. Please proceed.
Mr. Washington, you have 2 minutes. You may now speak.
Mr. Washington, you need to unmute yourself once you're invited to unmute.
So Brad is back. Shall I proceed with Mr. Imamura?
Okay, we'll try Mr. Imamura. If you can unmute, and you have 2 minutes to address this agenda item, please.
Mr. Imamura?
Okay, thank you. I guess your IT person or whoever controls this won't allow us to unmute, and so there's no way for us to do that. We don't have control over that. So, anyway, at least I didn't in the past. Anyway, I don't want to use up my 2 minutes. The active-passive management debate is going on for as long as I can remember. So, I think it would be good to compare, to see, had we invested the fund in passive management, what would have done over the past, since COVID, let's say, for example. I think it'd be an interesting look to see how that is. And the other thing is that, and you cut me off last time, I was trying to indicate, I noticed a number of trustees have been going to these conferences at the cost of thousands and thousands of dollars.
Well, I'm sorry, but I don't.
And I wonder, why do you go to
Can we
the
mute these
conferences that
speakers?
talk?
It's not relevant.
It's not relevant to this agenda item. We need to address only the agenda items at this point. So I am going to be very strict about this going forward. Is Mr. Washington there to address us?
Mr. Washington, can you hear me? I requested to unmute you.
No? Okay, well, we'll move forward.
Move right along.
Thank you all. We'll move to the next agenda item, which is 3B, presentation of private equity report by Newberger Berman.
Good morning. Today we have Casey Boyer from Newberger Berman presenting the Q4
Great.
2025 private equity report on a quarter lag basis. So Casey, please go ahead.
Great, thank you. Again, as always, appreciate the opportunity to present to the board. As Dinesh mentioned, we are going through year-end 2025. And I would say for the quarter, we did have slight increases kind of across the board. And as a reminder, if you look at the middle two columns, labeled Series 1 and Series 2, those are in partnership with Newberger. Series 1 is fully committed, still has some dollars going into the ground, but also is now in very much a harvesting mode. Still definitely has investments maturing, and we will continue to see valuation uplift. But at this point, we are seeing some good realizations within the portfolio. In Q4, we did receive about, almost $3 million of capital back. 2026 has been much better so far than 2025, and we've seen some really great realizations. In fact, year to date, 2026, within that portfolio, we've gotten back about, return to your team, about $14.5 million. We also have one other co-investment that we just realized a partial realization on with another 1.5 million coming back. And I just saw an email this morning of another co-investment realization. So we're really excited about some of these investments that have come through as realizations. As just an example of an investment that was realized in May, it's a co-investment, but it also happens to be an investment that is in a fund we are investors in. And that investment is an independent wealth platform that was actually taken into a continuation vehicle. So we saw a large realization through that, about 40% of that current NAV. So we've received over 2.5 times our money back already, but we still have a ways to go. So at Q4, this investment was being held at over 5 times. So we'll still see some realizations there, but a good return back to your portfolio. The Q4 returns for Series 1, we did also see a little bit of an uptick, 1.98 to 2.01. So as a reminder, that is basically saying that for every $1 of capital into the ground, it is now worth $2. Turning to Series 2, this is where we are currently committing out of. So it's early in the program and dollars are still being committed, dollars are still being invested. When we invest, as a reminder, those investments go in at cost. So we, however, did see a little bit of a markup in Q4 as well, moving from 1.17 to 1.22 in Q5 on a net basis. When we look at Q1, when we kind of look over our entire platform and we see where realizations are coming in, and these are just estimates, for Q1, we're seeing buyout pretty much on par. We're seeing venture and growth up, could be about 3%. And we do think that could very much be the case within your portfolio based on some growth investments that we have for Q1. Again, that is not fully complete yet, so I don't have final numbers, but we are hopeful for Q1. And then if we turn to one of the back pages, page 11, you'll see the returns across primaries, fund investments, secondaries, investments we're able to buy typically at a discount, and then co-investments, and kind of the commitment amounts between all of them. Again, you'll see the net performance moving up slightly from Q3 to Q4, and this is just Series 1. And kind of how we lie in the peer benchmark, definitely above median and really hitting close to that first quartile. And if you would turn to the next page, Series 2, again, this is the current tranche that we are investing out of. We are doing the same strategy, investing across global markets, across asset classes within primary, secondaries, and co-investments. Again, you'll see that slight uptick in Q4. And as I mentioned, very much a developing portfolio that we expect to see much more from in future quarters. And so with that, I will take a pause and open up to any questions, if there is any.
I have a question.
Thank you. Go ahead, please.
So part of what I've been thinking about when I look at this kind of information of where we are with private markets is what I'm hearing about some disruption that's happening with AI for software as a service. And when we look at this, we see the types of investments, but I don't really know really what's behind the numbers in terms of whether there's that kind of thing. And maybe this is a question for you, Casey or Dinesh, or maybe this is for our CIO. But when we look at asset liability, are we going to look at things like that? And when we review that, are we going to get deep into what kind of exposures we might have from disruptive technologies?
Sure. Let's see. That's a tough question to parse out here. The asset liability study is going to be, I would say the bulk of it is going to be working at a higher level than that.
Okay.
So instead of directing, say, sector emphasis for the private markets portfolio, you'll probably be looking at things, for private asset classes as a whole. So private, say, buyouts as a whole, or
Yeah.
VC as a whole, rather
Yeah.
than saying, I prefer, AI versus biotech, or kind of sector emphasis is there. You will have a chance, certainly, to look at different factors and different overweights and underweights as part of the process in the risk modeling. But it's not, I don't think that process is intended to give the trustees a chance to kind of direct the private markets team to be in one industry or sector over another.
So my question is not really whether we should try to direct them to be in a certain sector. My question is really, how much exposure do we have for things that we're not seeing returns on as a result of disruptive AI technologies? And is there underlying risk for some of these things that will not? Do we have an unusual level of exposure to these kinds of investments? Because a lot of companies are doing really well because of AI, but a lot of the software as a service kind of companies, which I think seem to be the golden type of investment for a lot of startups at one time. And I'm wondering, do we have exposure to that? And I don't know, this may not, so what I heard is the asset liability study won't give us that, but it would be interesting for us to hear at some point some kind of insight into whether we have an exposure in our private markets.
You certainly have that opportunity at the IC when they walk through the private markets review. And Dinesh, you can refresh my memory as to when that was?
The December investment.
Right, so it's coming up. The most recent one walk through different industry and sector focuses at a level of detail that I think would answer most of those questions. If you feel that December is too long from now and kind of the questions are urgent or pressing, we're certainly happy to meet with you and address those specifically.
Okay, thank you.
And perhaps to give a preview of our exposure to the AI theme within private markets, we've been cautious, and I would say even prior to AI becoming a big theme that's generated headlines, we've been focused on being aware of disruptors and potential disruption even in 2018, 2019. So our portfolio is more insulated in terms of our implementation of private equity buyout investments. So to share some specific examples, instead of buying high growth SaaS managers, we were investing in value-oriented buyout technology managers. So focused on things like corporate carve-outs, where there might not be as much growth, but you're also buying at a much more attractive valuation. So that's been beneficial to our portfolio relative to peers that have invested perhaps at higher valuations. We're not completely insulated from that. We do have some exposure, but less than others. We also have a venture allocation, which is investing in many of these companies that are creating the disruption. And all companies in general are trying to take advantage of the tools that are now available to them and pivot their business models and try to not get left behind, although there will be winners and losers. But in terms of private equity buyouts, we feel like we're going to be more on the right side of this trend. We've also looked at other parts of our private portfolio. So we've done some selective data center developments. We've also looked at the next level, things like power generation, which has been a theme even before AI data centers were in vogue. So something that we've been following these mega trends and informing our decision making and looking at it from a fundamental value-oriented basis.
Yeah, thank you.
Can I just
Go
comment
ahead.
briefly? I love that answer, and I'm not
Yeah.
sure that the staff can give the board any more detail than
Yeah.
that.
No, I
right?
think
mean,
that makes a lot
I
of
think
sense.
that's about, because if you look at SaaS in particular, there are a lot of companies that are overly beat up right now that will do just perfectly fine in the AI
Yeah.
era, and Dinesh doesn't know, and the managers who cover these asset classes don't necessarily know, and others will get beaten up. So I think any more granularity is really difficult at this point to be able to assess.
But what I heard is that we're not overly exposed to that.
Yeah, I mean,
Yeah,
that was
so,
a great
and that was a great
That was
answer.
great answer, but I think that's the level of abstraction
Yeah.
that we have to accept. I don't think we can get any more granular than that at this point.
I'm happy with that. Thank you.
Any other questions from trustees? Okay. Is there more to the presentation on 3B?
No, that's
Okay, in that case, I'll open it up to public comment on agenda item 3B. Are there any public comments? There are no comments. Very well. We'll move on to 3C. I believe Makita is in the room.
Thank you. I wanted to point out, I think the board is on mute. I don't know if that's on purpose or not, but I couldn't hear that last part of the discussion.
Okay.
Oh, whoa.
All right.
Can we just take a 2-minute break? We just
Okay.
want to confirm with the AV room in the back.
All right, let's take a 2-minute recess.
Recording stopped.
Why didn't I get my work call during this break?
resume our agenda.
Recording in progress.
Thank you. So we are on agenda item 3C, presentation of calendar quarter private markets report by Makita.
Thank you very much. Good morning. My colleague Colin Kowalski was planning to share the slides if he has permission to do that. Since he's more technologically savvy than I am. Thank you. So taking a look at the public version of the Private Markets Program Report, as you know, this is a quarter lagged. We can start on page 1 of 63, the next slide, and show each individual program, the legacy private equity of the Neuberger Berman Fund of One, and then each of the individual programs for private debt, real estate, real assets, and venture capital. You can see how long those programs have been in existence and how much has been committed, contributed, and distributed, and how much remaining value is left. These are relatively mature programs with the exception of venture capital, which is relatively new, especially for that particular asset class, only having started to have investments in 2021. On the far right, you can see the internal rate of return or dollar-weighted return in the column that's next to the rightmost column. That's the IRR for your pension plans, individual programs, relative to their public markets equivalent. So that's using a public markets index. And you can see that overall, most programs have outperformed their public markets equivalent if those same dollars were put into a public markets index at the time that they were called by your private markets partnerships and distributed at the same time as well. And you can see that the internal rate of return for the full program since its inception is 8.5%. On the next slide, we get into the private debt program. You can see here that the IRR as a whole was 6.5% since inception, and that commitments on the next slide during the quarter, there were 2 of them to Eagle Point and GC Customer Value, each in the amount of $7 million. If we take a look at page 5 of 63, you can see the individual partnerships, and really I think what's more relevant is on the next slide on 7, where you see the most recent commitments. And you can see on the far right how their internal rates of return compare to a peer IRR for the same asset class and vintage year. So a lot of success recently for these investments that have now reached meaningful returns. Real assets starts on page 8. The total IRR for the real assets program is quite strong, 11.9% since inception. There were 2 new commitments on the next slide, Soraya and Tembo, in the amounts of $8 million and $5 million. And then on page 11 and 12, we get into the individual partnerships by vintage year. And again, most of the most recent partnerships invested by your current staff under the current model have been quite successful relative to peers. The real estate program starts on page 14, has had an IRR of 6.1%. No new investments or commitments during the quarter that we're taking a look at. And you can see historical returns for the individual funds on slides 17 and 18. Moving to venture capital, as I mentioned, this is the most immature program starting on page 26, an internal rate of return which has just become meaningful at 3.2%. This program is still below its policy target significantly. Right now, it's only about 1.7% of the fund relative to a 4% target, so still sort of coming into its own as a program. There was 1 new investment on page 27, $5 million into Mighty Capital Fund 3 during the quarter. And then we have the individual funds on slide 29. And as you can see, some of these are not meaningful yet. And as you know, it does take many years to realize value in venture capital investments. We do have about half of the book devoted to slides on the market environment across these different private market sectors, starting on page 31. But in the interest of your time, I will end my comments on this report there and take any questions.
Thank you. Are there any questions from trustees? I had a question going back to the first slide. Is that page 2?
Sure.
No, page 1. And it is the wide divergence here between the IRR and the PME IRR under venture capital. It's gotten wider from last quarter, and quite wide. Any comments upon why that is and what that means?
Yes, so
And if you could remind us, what index are we using for the public markets equivalent
I can
in
tell
this,
you that
in
once
this case?
Mitch talks about it.
for venture capital, it's based on a public equity global universe. So the reason that there is this wide gap is because venture capital, as you can see, this is our newest asset class that started in 2021. Venture capital is the asset class that takes the longest to mature, longest fund life, longest start to finish for each investment. So for our program, the investments that we've made is primarily concentrated in early stage investments. So these are, in particular, the investments that take the longest to mature and eventually get realized. So we're still in the early stages. There's funds that are going through the J curve. For venture capital, the funds have a longer J curve where they're paying fees, making investments, holding those at cost for a long time period. So that explains the majority of this gap between public markets, which have done very well, these private investments in venture capital that are being made, but it's still too early to tell how they're doing. There's been some markups, which is explaining the 3.2% positive IRR as a program as a whole, but many of these investments are held at the investment cost that they're investing at. Managers are charging fees. So this will take probably multiple years before we start to see larger venture capital returns for the program.
We're using the same public equity index as we are for private equity. One could argue perhaps small cap would be more appropriate, and then I think you'd see a closer, less of a gap between the PME and the program.
That would be an interesting data point to
I think
look
we
at.
could look at that.
Thank you. Any other questions from trustees? Okay, if there are no other questions from trustees, I will open up for public comments on agenda item 3C. Are there any public commenters for this agenda item? There is a public comment. Please proceed.
Chair, we have a public comment. Please state your name. I believe it's Brad Imamura. Mr. Imamura, you have 2 minutes. Please unmute yourself, and your time starts now.
Mr. Imamura?
I requested to unmute himself. Mr. Imamura, can you hear me?
Yeah, this process is really bad because you're controlling the microphone. Anyway, this is a question for your consultant, Makita. Can you hear me now?
We can hear you.
Okay. I don't want to belabor this issue, but how much of this report was AI generated?
None of it.
None of it. Okay, I'll quote you on that. So none of this report was AI generated. Thank you.
All right, thank you. Any other public commenters? There are none. Thank you so much for the report. We'll move on to agenda item 3D, which is the calendar performance for the full pension plan.
Thank you. So setting the stage with the market environment, I'll start on page 5. The first quarter was very different from what we've seen in the second quarter to date so far. If you take a look on both the left or the right, really the only significantly positive asset class for the quarter and the only positive asset class at all for the month of March was the commodity index. Of course, that relates to the conflict in the Middle East and higher oil prices and commodity prices. However, if we look at the quarter to date since April 1st, the S&P 500 is up 14% through yesterday. The MSCI Emerging Markets Index is up 28.2% since the 1st of April. So we've seen a significant reversal. The All Country World Index up 15%, and that's why you'll see in this report a fiscal year to date return that's slightly behind your actuarial assumed rate of return, but your CIO reported that our estimates more recently are for a fiscal year to date return that's about double what your actuarial assumed rate of return has been. If we highlight some of the significant areas of this report, as you know, there is a watch list. I know that one of your investment officers talked about manager changes there recently, so I won't reiterate those. But if we look at the total fund on page 35, you can see the asset allocation. $3.67 billion as of the end of March. There was a slightly negative return for the first quarter, so there were 26.4 million reduction in the market value due to investments, and also 6.3 million in net cash outflows. And you can see that the current allocation and the overlay positioning were quite close to policy's targets as of the end of March. The performance is on the next slide, on 36. You can see that for the 3-month period, the return was negative 0.7%. So your managers in your portfolio and the positioning did protect relative to your policy benchmark, the investable benchmark portfolio, and the low-cost passive portfolio in the down market environment. I know one of the questions that we've had so far in this meeting was, since COVID, how has the fund done relative to passive indexes? And you can kind of see that exactly with the 5-year return. Since March 31st of 2021 to 2026, you can see the fund had a return of 7% per year relative to the low-cost passive portfolio return of 6.5%. So that's about 50 basis points per year. If we were to look at that on, say, a $3 billion starting value with no interest or compounding, that would be about $15 million a year or $75 million in added value over the 5 years. If we look at it with compounding over that time, you see about $100 million almost in additional return. And you also see for that 5-year period the rank in the top quartile in the 22nd percentile. If we look more recently at the individual asset classes, you can see sources of return, quite strong absolute returns for global equity, though a bit of a lag relative to the all-country world index. I know there was discussion earlier about active managers failing to keep up with indexes, and that certainly has been a trend recently. But again, want to focus on that full market cycle when we look at the value of active versus passive. But you see a lot of, if you look at the 1-year return period, a lot of incredibly strong absolute returns across the equity market. I also like to focus not only on return, but risk during these presentations. So a highlight of that is on page 64, where we look at the trailing 5-year period, and we look at both return, volatility, and also risk-adjusted return. So the trailing 5-year return has been in the top quartile, the fund up 7% per year on average relative to 6.5% for the median. The standard deviation has also been lower than that peer group. So the total fund has had a standard deviation over that time of 7.5%, both lower than the benchmark and the peer median, with about a little over 100 peer funds in this universe. And so you can see the risk-adjusted returns rank right around the top quartile over that period. Of course, there's a lot of endpoint bias whenever we're looking at returns as of a certain date, as we already talked about, March 31st being very different than if we were to look today. But 5 years is often accepted as sort of a market cycle type period. So I'm happy to take any questions on the pension.
Great, thank you so much. Are there any questions from trustees? I've got a few questions. If we can go back to slide 32, I think it was, or slide 31. So, 35, I'm sorry. So this reflects our previous allocation categories, and we were about to discuss finalizing a change in the categorizations where we are combining emerging market debt, high-yield bonds, and investment-grade bonds into a single category. I presume going forward, we will present according to the new allocation definitions.
Yes, I'd expect that to start. Once a new IPS is discussed and possibly approved, then that change goes through to the custodian bank, which is sort of the official book of record, and that will be then reflected here.
And I'll give you this opportunity to opine on that change. Is that something that other peer plans are doing in terms of combining into a multi-asset bond portfolio, combining these and collapsing these different categories into a single one?
I would say that every institutional fund is different in terms of how they categorize things. The fact of using growth and low beta and other is something that not everyone does. Some people might have different categories. Some folks would say growth, and then fixed more of a risk mitigating category. So how you categorize is very different. But that said, yes, I am seeing a trend. Another $30 billion public fund that I work with a couple of years ago changed to have an income strategies category, and they have public income strategies and private income strategies rather than breaking out high yield bank loans, emerging market debt, and other types of fixed income. And then we're also certainly seeing that trend on the investment management side. Of course, that doesn't mean anything. We don't want to have the investment management community drive the bus in terms of how we're doing reporting or investing for the funds that we work with. But that said, they often respond to shifts in what large plans are doing. And so you see a lot more investment managers offering strategies that are, we call them MAC, or multi-asset credit. And I think that's a response to just the fact that institutional investors and advisors are not in the market every day looking at every issuing company that puts out fixed income securities and being able to say, this one makes sense today, maybe we buy this other security tomorrow. So there's an opportunity to be more opportunistic there.
Okay, thank you. And just another question about a comment you made over on page 36. You compared our 5-year aggregate performance with the low-cost passive portfolio. Remind me, the low-cost passive portfolio reflects what split between growth and high beta and low beta assets? Is that a 60-40 or?
It's the same split as you have. So it's taking a more granular approach than 60-40 and looking at each asset class that you have in your portfolio. What is the most relevant index? So we do have a lot of slides at the back based on, in terms of all of the backup that we're using for each asset class, but it's all, the low-cost passive is all investable, what you could do with public markets indexes.
Okay, so it would resemble our 76% growth allocation.
That's correct.
Okay, so it is an apples and apples.
Yes, and a 60-40, you can see the MSCI, IMI, and the global aggregate there, which for the 5-year period was 4.8.
Yeah.
4.5. My eyes are not as strong as they used to be. So, yes, the difference between your returns and a 60-40 has been even much more stark than your particular low-cost passive portfolio.
Right, as one would expect, as with a higher exposure to risk.
That's right.
Any other questions from trustees on this agenda item? Is there any public comment on this agenda item? There is no comment, so thank you so much. We will move forward to item 3C. I'm sorry, 3E. Thank you, which is the Healthcare Trust.
All right, I will be quick here. The Healthcare Trust recently crossed over $500 million in value. Its asset allocation is shown on page 33, where you can see that the current allocations are quite close to policy. The high amount of risk in this fund relative to other healthcare funds, and the fact that it's completely implemented through public markets means, and especially a lot of index funds, has been very positive for returns recently. And on page 34, you can see that the fiscal year to date return through the end of March was 8.4% in the second percentile of the peer group, with the first percentile being the best. And then you can see that the 1-year return was 15.6%. So very strong recent performance. This fund has been sort of ideally positioned for just the unique market environment that has taken place recently.
Great, thank you. And remind me, did we choose a different discount rate for the Healthcare Trust the last year, or we have the same discount rate for both plans?
I believe we bumped it up a quarter.
We did bump it up a quarter. Yeah. Okay, so it's 6.75.
No, 6 to 6 1/4. It's had a different discount than the pension to start with.
Mm-hmm. Okay. Any other questions from trustees on the Healthcare Trust?
Yeah, I have one. Did you say that this one is more index focused?
That's right.
And that's why it's performed better?
Because it has a lower asset size, it can't do a lot of the same illiquid investing, and also because of the situation of it needing to be more liquid from an actuarial benefit paying perspective. There aren't illiquid assets beyond, I believe, core real estate in this fund. So everything is quarterly or daily liquid.
Okay. Any other questions from trustees? Are there any questions from the public on this agenda item? There is none, so thank you very much.
Thank you.
Right, I think we will squeeze one more agenda item in before we take a break and prior to our time certain at 10 o'clock, and that is 3F, which is discussion and action on implementing the changes to the asset allocation that I alluded to just previously.
My understanding is that's literally the only change is to create this omnibus bucket for some of our fixed income and bond, not fixed income, our bond exposure.
Right.
If that's the case, I'll make a motion to approve.
I have some questions before we proceed, if we can.
We can discuss after a motion as well.
That's true. Well, if you want to make a motion, okay.
That was just for efficiency's sake, but let's have a robust
Okay.
conversation.
And indeed, these are the changes in red line that you are highlighting here. And
Yes.
if you want to proceed with your presentation, please go.
Yeah, sure. It'll be really short. We just had a little discussion with Makita a minute ago. This was approved, the strategic asset allocation was approved at the May meeting that was recommended by Makita. The revised allocation consolidates high yield emerging markets and investment grade bonds into a multi-sector bonds category while maintaining the same targets. We are requesting approval of the asset allocation section of the IPS and the resolution number 9134 to memorialize the changes. And this would be effective July 1st, 2026.
Okay, any trustee questions on this? So my question, if we can scroll up just a little bit, is on the associated benchmark that we are using for this category. And I have two questions here. One is, help me understand what a dynamically weighted blend means. How is it dynamic? And I'm not sure I understand how the sub-asset class percentages add up to 100%.
The dynamic part is the benchmark weights change based on the board-approved the strategic asset allocation. So when the boards change the allocation that's on top, when they approve it, the benchmark weights change at that point.
So that would happen only when we make a strategic asset allocation change,
Yes.
once annually, presumably, or less often?
Yes. So the intention of moving towards multi-sector bonds was to not make any changes to the benchmarks themselves. So this is exactly what the benchmarks were before. I think what's confusing is now that we have all these subcategories, there's, for example, the 54.55% investment grade bonds. That has a custom blended benchmark, which has those subcomponents that make up the 54.55%. So the three categories that get added up are the 54.55% investment grade bonds, 18.18% high yield bonds, and 27.27% emerging market bonds. So that's the three categories that previously were standalone allocations. Now they're being combined together.
I see. And so that percentage split that you just described, they are fixed until such time as what triggers a dynamic change in that benchmark?
Only if the board were to change the mix or the percentage for each of those subcategories. So the benchmark and the subweights that are used for this benchmark are under the purview of the board. The implementation of the multi-sector bonds is where staff can make changes within this this target allocation, where we could hire a multi-sector bond manager or implement our own overweights or underweights.
I guess I'm trying to understand. I thought kind of the point of doing this aggregation was to give investment staff the flexibility to shift between the various subcategories with greater ease.
Yeah, exactly.
It is. So our implementation, we're free to make changes within that. The benchmark that we're held against is what it currently is. So we're still going to be benchmarked the same way as before. Any active decisions that we make, you'll see that as outperformance or underperformance relative to the multi-sector bond benchmark.
Okay, so the benchmark only changes when the board takes action.
Yes.
But the actual investments can change at the discretion of investment staff.
They can, yes.
Okay, now I understand. Any other questions? And would someone like to formulate a motion?
Yeah, I will resurrect my motion here.
Okay.
To approve the changes to the IPS.
Very good. Do we have a second?
I'll second.
We have a second. So that's a motion by Chandra, a second by Abbott. Any further discussion by trustees? Any public comment on this agenda item? There's no comment, so we can now vote. All in favor? All opposed? Carries.
Thank you.
Okay. It is 9:47. We have a time certain at 10 o'clock, but I think in order to have a smooth transition, let us take a 10-minute break at this time, and then we will get into agenda item. Which agenda item is it?
C, I think. 5C.
Yeah, 5C. Okay. So let's have a 10-minute recess, and then we'll be ready for 5C. Thank you. 10 a.m.
Progress.
Thank you. It is a time-certain agenda item, which is item 5C, which is a discussion action on the Gallagher Investment Team Compensation Study. So I believe we have someone here from Gallagher to present.
Yes, I'll give a brief intro while we unmute Georg. So Georg Kramer from Gallagher will be here to present the report. Just to help frame the discussion, Gallagher's report is making a recommendation. The board's action is to decide to accept the recommendation or an alternate recommendation, and then who will then be the representatives from the board along with police and fire to take it to the next step, assuming that to be a recommendation to City Council.
Okay.
Georg, are you online? Can you hear us?
Yes, I'm here. Can you hear me?
Great, yes.
Mm-hmm.
I'm not able to turn on my video, but I'm okay with that.
That's okay.
You are. And they seem to have been disabled maybe by the meeting host.
I'm sure we can take care of that while you kick off.
Yes, well, thank you very much. Good morning, everyone. It's a pleasure to be here, and I'm happy to present to you our findings, recommendations from the total compensation study that we conducted for San Jose's retirement services. We can probably scroll past the cover page there and the table of contents. You'll see in the report that initially is an executive summary that kind of just describes, briefly describes our methodology, the timing of the study, the components of the study elements such as the agencies that we surveyed. We call those comparator agencies. We identified 7 local government retirement systems that were included in the study, as well as CalPERS. And I'll talk a little bit more about kind of the dynamics or the relationships between the smaller agencies and CalPERS being sort of the gorilla in the group. And we also surveyed 6 positions. I'll get into a little bit more detail on that as well. And then, as I said, it was a total compensation study that included base salaries and benefits. I'll scroll down just a little bit to the market results. So getting right to the results there, we did 2 cuts of the data. I should also back up and say that all the data collection occurred before December 31st, 2025. That's important. We always select a sort of a cutoff date to make sure that all the data we're reporting is consistent throughout all of the agencies we survey. And the 2 bullet points you're seeing right there at the top of the screen now give you the 2 different scenarios, all of the details, all the data is in the appendices of the report. So we did 1 data cut including CalPERS and 1 data cut excluding CalPERS, because we wanted to see how CalPERS might impact the study and the study outcome, knowing that that might be a question that might be asked by various stakeholders. So the next couple of paragraphs describe the overall results. So when we look at all 6 positions combined and look at base salaries only, we found that San Jose Retirement Services was approximately 7.9% below the market. And when we at Gallagher say market, we typically mean the market median. So that's the measurement of the middle of the market, where 50% of the data points are above that value and 50% of the data points are below that value. And that market median is the market position that the predominant is the predominant target position that most of our clients have. And should also say that almost 100% of our clients are public sector agencies in California. What we then did, so we did 2 sets of analyses, one with base salaries. So again, the results for that, the aggregate result for all positions was 7.9% below market. When we then added the benefits for total compensation purposes, we found that the needle did not move much. It moved just slightly above 7.9%, almost 8% there. Again, almost 8% below market. So looking at the 2 values, again, we're comparing base salaries to total compensation, that tells us that that San Jose Retirement Services benefits package is quite competitive with the market, because it didn't move the agency, did not move your agency any further below the market or closer to the market. The market position essentially remained the same, and that means your benefits are competitive. When we look at results, individual results per position, and I'll get into that in a minute here, we usually look at anything that's outside of 5 plus or minus 5% from the market. That plus or minus 5% is essentially the place where we find that compensation is fairly competitive. Of course, a more narrow standard can be looked at, but that's in general what Gallagher considers competitive. Let's move to the next page.
I have a question.
Yes, please.
When you're talking about this methodology, was there any attempt to look at time in position? Because sometimes there's, someone might be really new in a position, someone might be way senior, and there may be a range of pay that's possible. Is that something you took into consideration?
Yes, actually, thank you for that question. That is a great question. All of the data that you're looking at in our report is based on the top of the salary range of the job classification, and it does not measure actual incumbents' pay.
Okay.
To exactly your point, that the incumbent in any of these positions may be currently at the bottom of the range, the middle of the range, the top of the range. So when we do these studies, we don't measure employees' actual pay. We measure the value of the position or the job that we're surveying. And in doing so, we look at the top of the range across all agencies, and that gives us an apples-to-apples comparison all across all of the agencies that we survey. So comparing top of the range to top of the range to top of the range at each agency gives us that apples-to-apples comparison, and it essentially kind of measures the maximum value of each job at each agency.
And at the risk of belaboring the point, when you used the word median a few moments ago to describe looking at the medians across different agencies, you're looking at the median of the top of the range. So it's a little bit
That's exactly right.
confusing
Yes,
or
that's exactly
counterintuitive.
right. So we're looking at the median top pay in the market. So when, for example, when we then build recommendations and we build salary ranges, we usually use the market median as the top and build a salary range downwards from there, because again, our measurement is the top of the range. The reason we do that is because it represents the maximum value of the job, and in most public agencies, employees are able to expect reaching the top of the range within a certain number of years. It's often anywhere from 3.5 to maybe 5 or 6 years. So that expectation to reach that point is mostly given in the public sector, which means it is a very reliable point of comparison. Whereas if we were to look at the middle of the range or the bottom of the range, those measurements are less reliable because every agency's range structures are different. And there's different differentials between minimum and maximum and the midpoint of the range. So the top of the range, in our estimation, is the best point of comparison.
And if you could just, I didn't quite write down that point. You said typically, how long does it take to reach the top of a range for in these positions?
It depends a little bit. So in your most traditional public sector compensation structure, where the range has 5 steps, and let's say it's a heavily unionized county agency, that time frame could be as little as 3.5 years, because the person comes in at step 1, often after 6 months they move to step 2, and then 3 years later they were already at step 5. We do sometimes see alternative range structures with 6 or 7 steps, then it may take 5 or 6 years to get there. There are also what we call open range structures that don't have steps, where depending on how wide they are, it could take a little bit longer, but predominantly in the public sector, an employee can expect to reach the top of the range within a reasonable amount of time.
Okay, thank you.
You're welcome. Thank you. So I'll go ahead and proceed here. What you see in the top, the very table at the top of the page there are the results for each individual position. And you can see there's a little bit of a range there. I'll address the first one there. The Retirement Deputy Chief Investment Officer was a position that did not exist at the time of the survey, but was a position that was being considered. And there was an interest in obtaining market data on that. That's why you see it says proposed there. So it was going to be a new position. We tried to measure it in the market, but we're not able to find sufficient market data. When you look at the second column there, you can see the number of matches or data points we were able to obtain for each job that we surveyed. And for this particular position, we were only able to get 3 data points, and we require at least 4. 4 data points is the minimum for us to do any kind of statistical analysis, to be able to calculate medians and averages and things of that nature. And we'll actually come back to this position because we are still able to make a recommendation, and I'll explain in a few minutes how we do that. For the other 5 positions, you can see the results. Again, second column there, number of job matches from the 8 agencies that we surveyed. The third column gives you the results for just the base salary. And you can see it does range quite significantly. You've got 7.5% below market, 13.8% below market. The retirement investment officer is 1.5% above market, but that's within that range that we consider to be competitive. So we consider that to be pretty much at market. And then we've got the senior retirement investment officer, almost 16% below the market. So that's certainly a place where we consider their compensation to be non-competitive. And then the final position there at the bottom of the table, 3.6%, a little bit further, the delta is a little bit greater to the market, but it's still within that plus or minus 5%. So again, we would consider the position to be essentially be competitive. And then the last column of the table gives you the results for the total compensation analysis, where we also included benefits. So again, you can see it does move the needle a little bit based on each individual position, but when we look at all positions in an aggregate, the needle did not move too much between base salaries and total comp. The next little table there just gives you our overall recommendations as part of the executive summary, and I'll get into more detail on that as well. But essentially what we're recommending in terms of salary ranges is that we would recommend no change for one position, an increase of between 1 to 5% for one position, and then 3 positions we would recommend a salary range increase of more than 5%. And I'll say that now as well, because that sometimes is a question. When we make recommendations in our reports, we're talking about the position and not the person in the position. So we're talking about just salary range adjustments, and not necessarily the adjustment of the incumbent's salary. And I'll get into that in a little bit more detail in a minute here as well. I see a hand up here. Is it...
We'll handle that during public comment.
Okay, good. Thank you. Let's keep scrolling down. I think that's pretty much it for the executive summary there. Yeah, please keep scrolling down. We're going to get to the more detailed report. So, for those individuals who want to read a lot of the detail, you'll find that in the full report. We're giving a little bit of a background, just explaining a little bit more about your organization. Of course, you all know this very well. The next section gets into the study methodology, where we talk a little bit more about each individual study element. For example, when we determine a labor market, the various factors that we think about. Of course, in your particular situation, because of the unique nature of your agency and the services that you provide, it of course is most logical to look at other public retirement systems to be most closely aligned with who you are as an organization. And when we select a labor market or a list of comparator agencies, that's something that's we pay close attention to. It's the organization type and structure, it's the services provided. Also, we do look at size in terms of either population served or customers or clients. number of employees, operational budgets. So we look at the labor market in terms of cost of living and cost of labor, geographic proximity, and things of that nature. So various different factors that we look at. And again, in this particular case, we surveyed 8 other retirement systems. Next page, please. Here's the list of the agencies that we surveyed. So included Alameda, Contra Costa, Los Angeles City, not the county, but the city system, Orange County, San Bernardino County, San Francisco, San Mateo, and then CalPERS. You'll see a little right here, give you a little bit more information in the next paragraph about someone might be concerned about comparing San Jose Retirement Services to CalPERS, for example. And that's certainly something that we're aware of. There's a significant difference between those agencies in terms of size. And that's something we really pay close attention to when we do the job matching. So for example, for technical types of jobs, or what we consider individual contributor types of jobs, we don't usually find a significant difference between those types of jobs, regardless of the size of the agency. But when we move into the management ranks of the organization, where an individual's responsibilities may actually grow as the organization grows, where in a larger organization, a job in management or an executive job might be more visible, it may be more political, it may be more complex. The individual may be responsible for much larger teams of people and so forth. That's where we pay close attention to job analysis factors that are related to decision-making responsibility, to the level of judgment that's applied in the job, the level of discretion, the number of staff, operational and financial responsibilities. And we account for the differences in size between 2 agencies. So I wanted to be, explain that to ensure you all that when we compare jobs between larger and smaller agencies, we still look for the best match between those types of agencies. And we also then looked at, as I explained, the next couple of paragraphs get into the difference between data including CalPERS and data excluding CalPERS. And we really found, when we looked at base salaries only, we found that CalPERS did not really have a significant impact on the outcome. So for the data including CalPERS, the result was almost 7.9% below market. And the data excluding CalPERS gave us a result of just about 7.5% below market. So it's a difference of less than half a percentage point, and that we find is not a significant impact. Our recommendations are based on the results that included the CalPERS data. Let's scroll down a little bit more. Just another quick list of the positions that we surveyed. We already saw that table. We can move along. There's a little bit more explanation on the salary and benefit data we collected here. So in addition to base salaries, like I said, we looked at benefits that included retirement, included deferred compensation contributions, health insurance contributions in terms of medical, dental, vision premiums that the employer pays for. We also looked at paid time off in terms of holidays, vacation accruals, administrative leave, personal leave, auto allowance, as you can see here, and then we looked at a couple of other benefits as well. And there are some benefits that we include in the total compensation calculation, such as retirement, deferred comp, health insurances, auto allowance, and then there are some benefits where we report just the policy, such as the number of holidays, the number of vacation days based on years of service and things of that nature. The next section, if we scroll down, just gives you a little bit more information on how we do the job matching, or how we actually perform a market survey. the gist of it really is that the crux of this part of the process is the job matching. You're really looking at San Jose Retirement Services job descriptions, looking at organizational structure and hierarchy and reporting relationships, looking at other job analysis factors. I think I mentioned it before, it's around decision-making authority, it's around the level of judgment and discretion that's applied in the job. So a variety of factors are analyzed, and we really do a job description to job description analysis. And knowing that no two jobs are ever going to be 100% exactly the same, we strive to get to at least a 70% match. So we want to be able to look at two job descriptions and say, yes, it's not the exact same job, but it's significantly comparable to say, yes, this is a match. I'll also say the 70% threshold is not a mathematical calculation we're able to make, but it's doing a job analysis, looking at job descriptions and all the other factors to then make an educated judgment call to say, yes, these two jobs are sufficiently comparable. Let's keep scrolling. I want to get to, we've already covered the market findings here in the executive summary. This is just sort of more detail on everything. We'll keep scrolling. I want to get to the recommendations. There's two data sets, again, based on excluding PERS and including PERS. We did do a little bit of additional data collection around other questions that the agency had around how does each comparator agency handle or administer their compensation structure and their ranges. So how do people move through the range structure? Another interesting question we explored was, are there any performance-based bonuses? And what the basis of those bonuses was, and really only out of the 8 agencies we surveyed, only 2 reported that they had any kind of incentive program. CalPERS program is really centered around certification pay, or kind of an award system for people to obtain certain certifications. So not really a performance incentive bonus program, if you will. And then the other agency, San Francisco, only had a program for their chief executive officer, and that was a signing bonus, also not really a performance-based bonus. And that is actually very rare, even in your industry. And I say even in your industry because, of course, for investment types of jobs, the question often becomes, is there something we need to do around performance and performance of the individual, but also performance of the actual assets under management? And so this often comes up with retirement system clients in the public sector, because of course they can see that in the private sector bonus programs can be very lucrative, but we do find in the public sector those types of programs are very challenging to implement. In fact, a couple of years ago, we did a broader market survey of over 20 retirement systems in California and found a similar result. Hardly anyone was able to really successfully implement a performance incentive program. We looked at some measurements around recruitment and retention. Just interested to see whether any of the 8 systems that we looked at had issues with retention. Didn't actually find too much of that, which I guess hopefully is a good sign for the industry. And there were also a couple of, some of these questions, not everybody was as transparent as you might expect in California. Everybody's very transparent with their job descriptions and their salary schedules and benefits, but some of these other questions are sometimes a bit, just a little bit more sensitive, so not everybody responded to our questions on this list. Let's keep scrolling. So recommendations, I'll sort of cut to the chase, if you will. The report explains a little bit about, of course, the fact that San Jose, the Office of Retirement Systems at San Jose is part of the city of San Jose, and so of course your compensation plan is tied to the city's compensation plan. Your benefits program is tied to the city's benefits program. So there are some there's some challenges in terms of flexibility or inflexibility, perhaps, of what could be implemented based on this market survey. So our recommendation is to focus on the base salaries, because the benefits program, changing the benefits program for just the Office of Retirement System would most likely be very challenging. And if you scroll down, we did make a salary range recommendation for each of the positions we surveyed. And again, please keep in mind, this is an adjustment to the salary range that we're recommending, and not a raise for the incumbent. And those are two very different things. So scroll up just a little bit so we can see the first title there, if you could. Yeah, I think that's it. Sorry, maybe I can't see it as well on my screen, but essentially I'm not even going to read all of it to you here, but you can see for each position we surveyed, we're basically recommending that a salary range on the city pay range schedule be identified that's closest to the market median, because that is how you would move each position to the market to be able to offer competitive salary range. Again, we will be looking at the market median, and then we would recommend looking at the city pay range and looking for the range whose top step is closest to the market median, because as we've discussed, all of the data is based on top step. And so we're recommending that for each of the positions. And then finally, I think that the bottom of the list there, if you scroll down, as you may remember, we weren't able to find sufficient matches for the retirement Deputy Chief Investment Officer, but we're still able to make a recommendation based on internal relationships. So in this case, we're recommending placing this position 15% above the highest level classification that's being supervised by that position. And that's a fairly standard differential that we can apply. That's kind of an industry standard across many career ladders, many job families. And we also looked in the other direction to make sure we weren't creating any compaction issues with the chief investment officer, but there is sufficient room or a sufficient percentage between the deputy chief investment officer and the chief investment officer if you were to follow our recommendation.
I have a question, and I'm actually looking at a different, I'm looking at your slides where you have all of the current top monthly salary and the recommended monthly salary, and it shows for the deputy CIO that the current top monthly salary is $26,250, and that the recommended is $28,715. So I'm wondering how we got from current top to the recommended, since we don't have a position yet. Or was there a position that was approved?
So I can address that. When we initiated the study, we were in the process of establishing the classification of deputy CIO for retirement services through the city's classification process. That has been defined, approved by city council, and is now an official classification.
Okay, thank you.
Sorry, Georg, unless you wanted to add something there.
And I was just wondering.
No, that's perfect. And the way how we came up with the 28,715 is basically saying, looking at that 15% differential between the deputy chief investment officer and the highest position it supervises, which is the senior retirement investment officer.
Okay.
And that's how we arrived at that dollar value. The final piece of the report, really quickly, was just we were asked to look at the more city-centric position or job classification of investment officer compared to the job classification of retirement investment officer. And really, the gist of it all, we did a very detailed analysis there comparing both job descriptions very closely. And the gist of it really is that there are quite a lot of similarities still between the two jobs, but we did find that the retirement investment officer is much more focused on retirement investments specifically, whereas the city's investment officer has other financial related duties in terms of financial operations and things of that nature. So it's a little bit of a broader, more generalist type of job. compared to the retirement investment officer. And when we look at educational requirements and years of experience, they're a little bit more specific to the retirement investment subject matter expertise compared to the investment officer. And that leads us to believe that it would be appropriate not to necessarily tie these two job classifications together in the same pay range, but to really separate them and treat them as two separate bodies of work. And really, of course, the retirement investment officer also has a different market. The market that we identified by serving those 8 other retirement systems, whereas maybe the investment officer from the city might be more broad, where you could potentially look at other cities and look at more broadly defined generalist type of investment officer types of jobs. And that's really kind of that's the conclusion of the report, and I'm happy to answer any other questions.
Okay, thank you for that very comprehensive presentation. Before I ask for trustee questions, I did want to add a few words of context, which is why are we discussing this? As a result of Measure G, which was passed in 2014, the two boards have the responsibility to suggest and recommend salary ranges for CEO, CIO, and professional investment staff. And it is City Council that then approves any suggested and recommended changes. And in the 12 years since 2014, there have been no changes approved for investment staff. So this would be the first time that we are recommending, or we might recommend, or we can consider recommending any changes. And another data point to consider, I believe we have 2 of our current investment staff who are at the top of the range, top of their existing current ranges. So that's the situation where we lay. So with that,
May I add one more?
Absolutely.
I think it's important to note at City Council this past Tuesday, they approved the Unit 99 agreement. And as part of that agreement, all of our investment professionals, CEO, CIO, are part of Unit 99, as well as some other staff across the office. But as part of that, those salary ranges will be adjusted in the coming year by 3%, 3% each of the following 2 years. So I just think that's important because that's a fairly new development. Obviously happened Tuesday of this week.
Right. So if we were to recommend a salary increase, it would be on top of the 3%, which is not exactly meant to be a COLA, but it very often seems to reflect the cost of living adjustment.
And I'll just point out that in the report, in the detailed section, the question was asked of our peer pension funds, were there any planned adjustments coming up like the Unit 99 agreement, and some of the plans responded with some values and some percentages rather, but I would say the majority of, no different than how we would have answered if we were asked back in January, unknown. Because back in January, we knew this Unit 99 agreement would expire the end of June with no agreement yet in place. So I think that's important when you're considering your process.
Right. So all those peer plans, from December till today, the end of their fiscal years, the target is moved, the bogey is moved.
Likely. Right.
Yeah. Okay, with that, I open it up to any trustee questions about the compensation study.
I have a comment, actually.
Please.
I mean, I'm a little surprised at the selection of our comparator agencies. I mean, I just took a look at them, and a lot of them seem significantly larger than our own agency. I mean, I think the smallest is San Mateo County, apparently, and I think they have like 13,000 members. How many members do we have?
We had just over 16,000.
16,000, okay. I mean, I think a lot of them are about 25 to 50,000, and I think they have assets of about 13, 14 billion, 25 billion. I mean, I think these are significantly larger agencies, it seems to me.
Noted, I think another consideration is they are all urban coastal California peer plans We're not looking at Modoc County and places like that, so I think that was part of the consideration. I don't know if Gallagher wants to comment on the selection of peer plans.
Yeah, I can have a quick comment here. There's two things that we try to accomplish when we select comparator agencies. One is to represent who our client agency is, and again, that goes back to organizational structure and yes, size, but also services and programs. And so that's one piece. The other piece is to represent the local labor market. So of course, as you all know, the Bay Area being a very unique labor market, that's something that we wanted to accomplish in including Alameda and Contra Costa and San Francisco and San Mateo. So half of the agencies are located in the Bay Area, but then also wanted to look at some other systems that were a little bit closer in size, perhaps, and looking at by looking at things like assets under management, number of employees, budgets and things of that nature. So it's a bit of a mix, and of course, again, one of the reasons we did 2 data cuts, including and excluding CalPERS, was just because that agency is so much larger, but also as sort of a competitor when it comes to the competition or the supply and demand for talent, that this is hard to ignore. So we did 2 data cuts to make sure that CalPERS didn't have undue influence on the outcome. And again, as I mentioned before, even when we compared organizations of different sizes, we're able to compare jobs in the most fair, the fairest and most accurate way that we possibly can. We call it leveling sometimes, where if we look at an executive management position or just a management position at a smaller agency and compare that to an executive position at a larger agency, we may look at the next lower position at the larger agency, or sometimes we even apply what we call a hybrid match, where there's a higher part to the match and a lower part to the match at the larger agency, where the position from the smaller agency falls somewhere in between. So there's different ways that we're able to address the difference in size between different agencies. Probably more than you needed to know, but explain it a little bit better.
Okay. Any other trustee comments or questions?
May I make a comment about
Please.
the contract that we just approved
Mhm.
for the agreement with Unit 99? It's not just the 3% increase to salary effective June 21st, but there's also a 1% one-time lump sum payment to all Unit 99 employees in addition to the other bargaining units that we settled with earlier this week. So that's effective, and those are all non-pensionable funds.
I think
Just wanted to clarify that.
Okay, thank you. Did not know that.
I think it's also worth noting, just so everybody understands the mechanism, because we do have a few people at the top end of the range. When Unit 99 adjustments happen based on that agreement, if you are at the top end of the range, it's not that you don't get that increase. You don't get an increase, but you receive a cash lump sum. So that money is paid to you, but it's just not compounded over a year, right? So,
So your salary range doesn't go
your
up.
salary doesn't change, your biweekly income doesn't change, but you do receive that as a cash payment whenever that is administratively processed. So very similar to the lump sum that Vice Mayor Foley mentioned. The people at the top end of the range do get that. It just doesn't compound.
Mm-hmm.
I have another question. Have we seen issues with recruitment and retention?
I'll let our CIO address that.
Yeah, the most recent position that was open was mine, and from my understanding, it was quite heavily contested. So it's been a while since we had an investment officer analyst opening. We've always had pretty decent turnout, depending on the position and the timing. Maybe just a general comment, though. In the leveling process or the search for comparator agencies or even comparator positions, it's very difficult, right, to find a similar position and to establish a market for that job. I would say, I'm sure there are plenty of larger plans out there with cheaper staff. And just as there are smaller plans out there with more expensive staff, because of the nature of the role that's being hired for. And I would take it back to your upcoming work with the asset liability study. When you want an asset allocation that's complicated, that features private markets, that features active management in public markets, you're asking for a portfolio that's not just complex, but complex to run, right? You don't want a complex portfolio just to turn around and staff it with, the cheapest staff you can find. Okay, all right. You want to have the right pieces in place, from staff down to resources, to get the maximum benefit of the asset allocation that you've selected. If in a couple months you turn around somehow and decide that you want to go with a low-cost passive portfolio, you want to be all passive, then it's my job then to turn around and say, okay, we need to be resourced for that type of asset allocation, right? That's an entirely different way of running a portfolio. In that scenario, we'd have to make some changes, right? You'd expect us to make some changes. In the scenario that we're in now, where you've requested, and I think you're going to continue to maintain that request, a complex portfolio. We need people with a certain set of skills. Before I go all Liam Neeson here, where those skills don't come cheap all the time. And I would guess, even the survey kind of understates the market for that set of skills.
I guess I would share my perspective, having served on the board for over 6 years. We've had a very good run of success. We have breached the 70%, or expect very shortly to breach the 70% valuation. And I know in our process of hiring a CIO, one of our North Stars was continuity, to maintain the momentum. And I think we want to set up a staff and a retention where we can maintain the momentum we have achieved. And that's very important to us, and not to have a big disruption to that. And in terms of comparative agencies, I think you're absolutely right. Some of these other Bay Area counties may be larger than us, but they are proximate to us geographically. So if they're looking to poach new employees, they're going to be looking at San Jose staff. And if we are needing to hire someone, we are probably likely to be hiring someone from those staffs. So I think they loom larger perhaps than some of the metrics might indicate. That's the competition for us. So
I'll also note that we're about to open a recruitment for the competitive recruitment for the DCIO. So we'll also have some understanding about the recruitment and the market associated with that.
Mr. Chair, I share your perspective, having worked in all of this stuff, how people watch what everybody's doing. And they don't stay like they used to. They don't mind a 2-year shift or a 4-year shift by looking around. So I think it's important, in my mind, that we remain competitive with at least the immediate Bay Area, where the poaching most frequently takes place. This is a rare talent in field, in a sense.
okay.
That's my thought on it.
Any other comments? I guess we have two jobs here. One is first to accept the report from Gallagher, and then secondly, to decide what, if anything, we wish to do about it. So, Trustee Nakagawa.
Sorry, I have a couple of questions here. You had mentioned, Chair Horowitz, there were no changes in the past 12 years?
Well, they're the Unit 99 changes that come essentially with inflation, although that's not
but in terms of like a salary study?
We have done salary studies before, but City Council has never approved a change in the salary ranges in the 12 years. We have done that, I believe, for the CEO and CIO position within the last 12 years, but not for staff. So that's a fairly long gap, obviously, I believe.
Okay. And I'm just curious, did police and fire approve?
Police and fire accepted the report and made recommendation to accept the Gallagher recommendations and appointed someone to then present that to City Council.
Okay. Sorry, I have multiple questions.
Sure, you're entitled.
For the Unit 99 to 3% general wage increase, I believe that's for the next 3 consecutive years as well, right? 333.
Right.
And to confirm, that'll change not only the bottom of the range, but the top of the range, and will increase the pay of everyone in that classification as well, right?
Correct.
Given that information, does that change the proposal numbers from Gallagher, since the report was generated before that agreement was made?
I'll let Gallagher answer that question. If Georg, if you're still out there.
Yep, I'm here. Yeah, I can answer that. This is actually a quite common occurrence when compensation studies are done. The way we look at it is when you do a market study, you're basically trying to figure out how you compare to the market at the current time, and if you're falling below the market, what does it take to essentially catch up to the market? When it comes to these sort of more standard, often negotiated increases that are somewhat like COLAs, and I'm sure you all know that predominantly in the public sector, COLA adjustments are very common come July 1st. Most agencies do COLAs. And so a COLA is a little bit different from what we call a market equity study, which we just completed. A market equity study helps you catch up to the market. A COLA of 2.5%, 3%, maybe 3.5% once a year. Really, the function of that is to keep you, or to help you stay caught up with the market, if I can say it right. So there's 2 different mechanisms that agencies use to be able to catch up to the market and then stay caught up with the market and remain first become competitive and then remain competitive, because it's very likely that out of the 8 agencies that we surveyed, I would suspect all 8 of them will have some kind of COLA increase or other negotiated increase in the next 3 years.
But are we aware of what those increases are? My understanding is each agency has their own increase. Some may have lower increases, right, which would cause our basically general wage increase to allow a bigger catch-up, right?
I was on, I shared it. So we don't know what that specific number is. It could be higher as well. So we tend to treat that as an apples to apples and just focus on, right, because they're going to get increases as well, so over time.
And I'll just note that that question was asked of the peer group, and the ones that responded, they're actually in the appendix. So you can actually see some were below 3%, some were above 3%, but most said unknown because they were probably in contract negotiations or, similar to us where it's a city manager recommended agreement for Unit 99.
Okay.
I think we're always going to be a few quarters behind reality, because we could basically do the study again today, get the up-to-date numbers with whatever fiscal year increases were, but by the time they generate the report and everything, it'll be, several months out, and you could ask the same question then.
So I have a clarification question, because I thought we just heard that that if someone was at the top of the range, they'd get the 3%, but it wouldn't increase the salary range. And then I think you just asked, didn't it increase the salary range? So
Sure,
I'm confused.
Let me clarify. So the Unit 99 agreement it changes the salary range. So anybody who's within Unit 99 not only receives the compensation increase associated, in this case 3%, but the salary range also moves by that 3%. Every year we go through a merit-based process, a performance evaluation, and as part of that performance evaluation, merit-based compensations are determined. For those who are at the top end of the range, they receive that piece as the lump sum because they're already at the top end of their range. So that is what doesn't change. But somebody who's in the middle, they don't get a lump sum. They move in the range and then that compounds every year. Does that make sense?
Yeah.
Okay,
So
good question.
and I'm just looking at the recommended adjustments, I'm looking at the slide thing, and it looks like all of them would be bigger, with the except of maybe the investment operations supervisor would be bigger over time than those the recommended ranges than that 3%, so.
Maybe you have more questions.
Yeah, Trustee Nakagawa, I think, yeah, you had some more?
Sorry.
Yeah, more.
For the proposal itself, if we were to approve it, is the proposal to increase both the top and bottom of the range by that recommended percentage?
I'm not sure. I'm not sure the bottom of the range is, I guess it would be relevant if we were, hiring a new person to that position.
My assumption is the answer is yes.
Yeah.
I'm not sure that was specifically covered, but I think it makes sense in the recommendation, rather than increasing the range, keeping the range.
Consistent.
Yeah.
So if that were to happen, it's possible that that would force an increase in someone's actual pay if they were closer to the bottom of the range, and then that, the proposed increase, like say you're at the bottom, you're paid at the bottom of the range. If we put the proposal forth, it would increase, say, 7%, 15%, whatever. That might force that person's pay to actually increase.
When it actually goes through it, I have to rerun the numbers, but I don't think that was the case for any of our current employees.
Okay.
In fact, the analysis that I did said, from a budget perspective, right? So if you approve the recommendations and City Council were to approve it, we're talking about likely less than $5,000 over a number of years, cumulatively. So, I mean, the budget impact is extremely small because most of our staff are not at that top end of the range. And someone who would have been at the top end of the range is now sitting to your right, so we've solved that problem.
So, 5,000, that's across all the positions?
Correct.
Okay, so it's quite marginal.
That was one of my other questions.
Yeah, okay.
Yeah, well, I mean, one is a budget question, one is a personnel question,
Okay. I did want to point out a couple things. I think from the city perspective, salary studies like this are not triggered unless the vacancy rate is at 10% or higher. Obviously, I think it was noted that there's no vacancies in most of these positions, so I did want to throw that out. I think if Vice Mayor Foley might be able to help me here, but I think with the union contracts that were signed so far, I'm not sure if any salary studies were approved for any other classifications citywide.
No, I don't believe so. I believe that we have done classification studies in those bargaining units. There were a couple in others that are ongoing, but not related to those.
Okay, so I think the city's position is, given budget situation, I think salary studies have generally not been approved this budget cycle. So I did want to kind of throw that out there. I guess a question for Gallagher is, did the data in the report for the base salary, was that pensionable and non-pensionable?
It would have only been pensionable pay because we would have only looked at the salary ranges. So we would not have considered any kind of sort of bonus or lump sum payments above and beyond just the base salary.
So
because those are not guaranteed usually, and we don't usually take it into consideration. It's about the position and not the person in the position, and oftentimes lump sum types of payments are very person or incumbent specific.
So I did want to clarify, I think with these retirement positions, they're all classified for Unit 99. They all get an automatic 5% non-pensionable pay on top of their pensionable pay. This is for their hourly rates. So I just want to clarify, you're saying that the study only focused on the the pensionable hourly rate and the ranges?
Yes, I'm so sorry. You all froze up a little bit, but you're correct. We would have focused on pensionable salaries because we just looked at the published salary ranges from the city's salary schedule.
So I think for the group, overall, all of these folks are getting paid 5% above what those numbers in the report are showing. Now, granted, that 5% is non-pensionable, but that does, to me, count towards their
I'm not
salary.
quite understanding the 5% yet.
So, I think this is kind of unique to San Jose, but
Okay.
it's by union. So there's certain unions where it's agreed upon where, say, your pensionable hourly wage, let's just say for argument's sake, is $100 an hour. Because of your union agreement, you're actually getting an extra 5% on top of that, so which is non-pensionable. So the pensionable amount is 100, but your paycheck will reflect 105 per hour.
But does that affect Unit 99 who are not unionized?
It's
it does.
Yes, for Unit 99 it does. They do get an extra 5% non-pensionable pay on top of their pensionable base pay. Like it is unique to San Jose. I've not seen any other agencies have that. But, from a salary study perspective, we generally take total base pay, which includes both pensionable and non-pensionable. So I'm going to...
If I may jump in here, now that I'm hearing you describe this, we are aware of that 5%, and I want to say because of that unique aspect of that, being unique to San Jose, we did take it into consideration. Because I am now that I'm hearing this from you, I want to say we did, but I would have to confirm it for you. But we are aware of that additional 5%. I would be surprised if we didn't include it, because it is essentially part of the base pay. But I'd have to confirm that for you.
That's fairly significant, right? Because that's 5%.
Yeah.
That would swing these numbers quite a bit.
I'm going to do a quick check if you want to continue with your questions.
I think Matthew has.
Did you have anything more?
I'm sorry. I think I have one more. If we were to not approve this plan, or I'm sorry, is there an option to defer this to a future time when, say, budget situation may be better for the city? Or is it something like if we don't approve it now, that's it, we'd have to wait till another cycle or another a survey to be done?
I'll make two comments on that. I think the second point is correct. If we wait till a future time, we would have to redo the survey. Obviously, it ages rapidly and it would become useless. And the second, of course, is we need to act, if we do act, in coordination with police and fire. So if we elected to delay or not to act, and they did, I'm not even quite sure how we would resolve that difference. So there's that to be considered. So unclear what, the range of options we might have with that.
Probably to go back to JPC.
All right. Those are my questions.
Okay.
I have another comment. I mean, I took a look at a couple of these, and I think the retirement deputy chief investment officer, the recommended top, would be higher than a director position at the city. And I think the senior retired investment officer would be higher than a deputy director at the city. I mean, I know we're separate and we can make our own decisions, but I do think, we should take into consideration what city staff are being paid.
Vice Chair Faulkner, did you have a question?
Yeah, these may be for Gallagher. I'm sure someone in the room can answer this, but just to confirm, in terms of the comparables here, none of these, because I don't know if there's many in the country, none of these have two separate boards that they're dealing with managing a pension across two plans under the same umbrella. Is that correct?
Yes, as far as I know, that is correct. Your agency is quite unique in that regard.
Okay. So I think as an outsider, I think that the work is very similar in terms of when you see a job description, but there's always a marginal amount of additional work to keep track of and separate these things, and I think that's worth considering. Then the second question I had for Gallagher was, when you looked at these positions, these comparable positions, did you look at the number of positions in that specific role at each of these plans, or was it just the salary number? Meaning if Contra Costa County had, 6 starting investment analyst positions versus we have 1 or 2, right? Was there a number of positions that these kind of comparable plans had, or did you just leave it with the salary number?
We do look at position control information from each agency to better understand. That information tends to be more relevant for management positions, so we can understand how many people a manager might be responsible for example, or whether a manager has subordinate levels of supervision below them. If it's let's say if it's a manager, do they have a deputy or assistant manager and a supervisor and maybe an assistant supervisor, below them. So that's when we look at position control. When it comes to individual contributor types of positions, in your example, while we are aware of the position control information from each agency, it's not as relevant a factor that we analyze or that we consider when we match 2 jobs against each other from 2 different agencies. So it's more about the job description and the duties and responsibilities, whether it's 2 people doing the work or 6 at another agency is not as big a factor when we do this job analysis.
Okay, thank you. And then my last question, maybe for Maytac, and it's maybe a fringe related question, but the LA kind of court system that's going on, how does that play into this landscape, or is it completely separate, or how will it potentially? I know there's not an answer yet.
There's not. The case is still pending. There's no decision that has been issued, but fundamentally at issue at the La Serra versus Los Angeles County lawsuit, what it was at issue was whether or not the county, which was the plan sponsor, had the authority to deny the compensation requests, specifically related to IT and investment staff, regarding their recommendations for what they needed to run the plan. So that question, I think, directly bears in some degree to this plan. However, their body of law is slightly different. They're governed under the SERL, which is the Employees Retirement Law. It's different from what we have here, which is the city charter in our plan document. So there's a degree of difference, but the fundamental issue remains unresolved.
Thank you.
I have an update if you're okay. So
sure.
I just wanted to cross-check before I give you the answer. But the numbers posted in the report are the non-pensionable plus the pensionable. So just to be clear, so we can use an example, the deputy CIO position is classified as $314,999 as the total compensation, which is what the numbers are that we use in the report. But the non-pensionable, the pensionable amount for that is $300,000. So, so that's the 5% that we're talking about. So depending on how you look at it, you could say the salary's $300,000 plus a 5% non-pensionable, or you could say the compensation is $315,000, of which 5% is non-pensionable. However you want to look at it, but the numbers used in the report and the comparisons were based on total salary, not what was for San Jose, not what was pensionable.
So to further clarify, when Gallagher is suggesting an average 7.8% increase, it's compared to this full number, including the 5% uplift.
Yes.
Okay.
In the charts from the city, it's referred to as the approximate total maximum annual.
Approximate total maximum. I love that. Okay. All right, good. That means they did their work properly, which is always reassuring. Any other questions, comments, insights?
Chair, I feel compelled to weigh in on
Okay.
this particular issue. And if you bear with me, I have a long statement that I'd like to read.
Okay.
As you may know, we're still in ongoing negotiations with our 2 largest bargaining units, MEF and IFPTE. In light of the city's significant fiscal challenges in 26-27 and the similarly constrained outlook for 27-28, we're concerned about the recommendations that are being made. I think you expressed that. We prioritize compensation studies that may be used to support special salary adjustments for classifications experiencing recruitment or retention challenges, which we've heard isn't necessarily the case. ORS investment team's fully staffed, and to increase the rates at this point sends the wrong message to the rest of our staffs and may not be supported by City Council. I don't know. I haven't had the conversation with them. Given these circumstances, had these classifications been under any other appointing authority within the city, the administration would not have initiated a compensation survey because there is no demonstrable need to fulfill positions that we're not having a lot of people applying for. We're concerned about the broader relationship in relation to other labor negotiations that are in a very sensitive position right now. So, you know, this is a decision you have to make as trustees, but as the liaison, I just wanted to share with you the concerns as the council member who may be voting on these, and the concerns I have and that some of my council may have in relation to all of our bargaining units and all of our employees.
And
if that helps at all.
And so you, thank you, Vice Mayor Foley. So you've read that out. Is that, I'm not quite sure the provenance of that statement. Is that your statement, or is that coming from some other?
It's a combination of the administration and myself.
Okay.
City manager and vice mayor.
Okay, well, that certainly informs our understanding of the situation. Mr. Kwan, it sounds like you have something to add.
I do. Thank you. With your indulgence.
Mm-hmm.
I think when I look around the board, I see an earnest effort to kind of fairly determine whether a study is appropriate or if it should be passed over to City Council. But one thing that worries me a little bit is a little bit lack of institutional memory going back. Okay, when I started as an investment officer for this plan, I was one of, I got hired into a staff of 3, reporting to Arn Andrews. And that was after an intensive rebuild. Prior to that, going a few years prior to that, there was a long period of time where the investment staff was down to essentially 1.5 people and no CIO. And the root of that understaffing was, dysfunction perhaps at the board level that led to pay ranges that for potential employees, the trouble wasn't worth it. The end result of that lack of staffing at the plan level was just crippling underfunded status. And we're talking about, essentially billions of dollars. So when you listen to a potential financial analysis of the increase in ranges and hear numbers like single thousands of dollars in potential impact, even if he's wrong by an order of magnitude, let's say it's $50,000, that's compared to, again, billions of dollars in impact at the plan level. We've got a staff that, I don't want to say it out loud because I don't want to jinx it, but they're happy to be here. I don't know why they would be penalized for the fact that they're happy to be here. What does it take to improve their ranges? Like they all need to leave? I don't really understand that fact. You want them to stay, you want to incentivize them to stay. It seems fairly, it seems pretty straightforward to me to just get them to not even the top. We're talking about the median salary amongst comparator agencies. That's public plan universe as well. If you think about the different options available to them, it's not just working for another governmental institution. That's, I didn't have a whole lot of prepared remarks because I thought it'd be a little bit more cut and dry. But that's pretty much it.
I certainly take the point that, waiting for a retention problem to arise seems like a poor strategy for manning our investment staff. Now, if there's any other comments from trustees?
Would it make sense to, I know we have some public comment, but
Okay.
Would it make sense to defer this item? A couple of reasons. Maybe the primary being that there is the city is in negotiation with a few other unions that honestly not only that impacts almost all of our non-unit 99 employees at ORS, but for the city as a whole. There might be some more clarity in those discussions by the time we're able to reconvene. I hate to push out or recommend pushing out to another meeting just because there's no meeting in July, but and the data will become 2 additional months stale. But there may be some more clarity that we can bring to the board in August, unless you think it is cut and dry.
I second. I was going to recommend that. I was about to jump in and say that before CEO Flynn spoke. I think 60 days won't age the report that much. I think we'll have clarity. As someone who has been on the board for 10 years, I have some of that institutional memory that Jay Kwan is referring to. This was the second worst performing pension system in the country when I took over the investment committee. 3 years later, it was actually number 2, and it stayed top decile and top 20 percentile for almost 9 years now. So this staff has done a tremendous job, and I do think the metric of vacancy is backwards. We don't want to force people to leave because we're not compensating them at the mean of comparator plans, both geographically, because that matters, cost of living, as well as responsibilities. And I like that Trustee Faulkner highlighted that they have to report to 2 boards. But the city is also going through a certain period right now, and I think we should be sensitive to that. So my recommendation would be to revisit this in August.
Well, we have 2 separate items. One is to simply accept the report as a data input, and the second is to recommend action on the report. I'm wondering if we can at least accept the report and agree that it's been accurately and fairly compiled and aggregated, and it is an important data point going forward for us to figure out what we're going to do next. So I wonder if anyone would like to make a motion in that regard, simply to accept the Gallagher report.
I would like to make that motion. I think
Okay.
it's an excellent report, well explained, nice detail. Looks like we've had great compensation, great comparisons. It doesn't seem to be any bias in the report. So I think that the report is well done.
Okay, thank you, Trustee
I'll
Abbott.
second the motion.
And we have a second from Trustee Chandra. So now we'll have discussion on the motion from the trustees.
Oh, do we need to do public?
Yeah. Okay, is there public, well, I was usually swapping the order. Is there public comment on this motion, which is simply to accept the report?
Yes, we do have a public comment from Mr. Brad Imamura. Mr. Imamura, you have 2 minutes to speak. Please unmute yourself. Your time starts now.
Thank you.
Thank you. Yeah, I'm just finishing pulling myself off the floor. I couldn't believe what was transpired, but I'm thankful for the 2 employee representatives for bringing up the issue and questioning the validity and the necessity of this. And first of all, and ad nauseum, I've indicated to you that there are many public pension plans that are better managed, have better returns, and they don't have chief investment officers. And I can't believe the number of investment staff that was on this report. What are all these people doing? That's the big question. What are these people doing on a day-to-day basis? Investment analyst 1, investment analyst 2, senior investment analyst, deputy director investment analyst. What is going on? And then you're talking about an increase, and thank you, Vice Mayor Foley, for bringing up that report that you had. I hope the council looks at this and says, this fund, and Trustee Chandra, you indicated you've been on the board for 10 years. Well, I was on the board for 12 years, and I'm speaking as a taxpayer who happens to be a beneficiary. I'm on a fixed income, and these salaries are just out of sight. It's ridiculous. So you're going to bring it back in August, and I'm just saying unequivocally, do not accept the recommendation. This is ridiculous. In fact, you should be reducing staff. And on top of that, Mr. Kwan lecturing the board and CEO Mr. Flynn, you're letting him lecture the board? I cannot believe that. I can't believe you did that. This is ridiculous. Thank you.
Okay, thank you. Just one small correction. That was not Mr. Flynn who allowed our CIO to speak. That was the chair's prerogative. So I take full responsibility for that. So that is public comment. Any further trustee comment on the motion, which is to accept the Gallagher report? Seeing none, we can vote. All in favor of accepting the report? Opposed? The report is accepted. Do we need a separate vote simply to delay action on recommendations, or can we just?
I like the tabling formally.
Okay. So we need a formal motion to vote on tabling? No?
You can defer the action.
Okay, we will defer then.
There you go, Chair. Your prerogative.
I finally get to do something. Okay, I'm out. That's why they pay me the huge bucks. Okay, very good. Thank you for that very fulsome discussion on a very important topic. And now we will go to agenda item, where are we?
5D, I believe, is where we are.
Well, no, we didn't go over 5A.
A. Oh, I forgot
There was
A and
nothing
B.
under old business. Now we're on to the oral update from the CEO. So, Mr. Flynn, once again.
Good morning, trustees, Councilmember Foley, and our members. The City Council approved the mayor's June budget message last week and the budget appropriations this week. With these approvals, ORS headcount increased by 1 to 46 FTEs effective June 21st. I want to thank Benji and all the senior staff for creating a well thought out and reasonable budget. Also, Vice Mayor Foley, Councilmember Foley, and the Budget Office and the Mayor's Office team for supporting ORS through this process. Earlier this week, I attended the NC PERS Chief Officers Summit, and there were discussions reinforced many of the themes that were approved by this board as part of their strategic plan, including succession planning, technology governance, and staff reinforcement and training. As you know, Cynthia gave her notice last week, and her last day was Friday. I just want to take a minute to wish her well in her future endeavors, and I want to give her a personal thank you for the support she provided me during my transition to ORS and to the City of San Jose. Also, in terms of staffing, interviews for our vacant information systems analyst position is targeted for July, and interviews for our vacant benefit analyst positions were conducted last week, and we're hoping to fill also that in July. With the approval of City Council, we will now commence the recruitment for our permanent benefits program manager and our deputy CIO positions that will become effective June 21st. There's an agenda item later today related to an overstrength benefits division manager position. I've mentioned it a few times, but our benefits division manager, Sandra Castellano, is planning to retire at the end of this year to support the transition of this important leadership role within ORS. We're going to request the board allow us to recommend to the city that we create an overstrength benefit division manager position. Governance committee met yesterday. We had we have our first set of policies, red lines that came through the committee as part of the governance review framework. We had a good, robust discussion on the CEO, CIO, performance evaluations, as well as the board charter. I expect we'll be bringing those for board approval in August. On the procurement side, I'll just mention the previous catering agreement that we had with Specialties expired. We worked with the city while they completed a competitive procurement process to expand our catering options, and now we're working with the vendors that were awarded. Just a reminder that the Federated Member Workshop is Thursday, August 13th. We held a quarterly all-staff meeting on Tuesday, June 2nd. We discussed the board's strategic plan, including the mission, the vision, and the core values. Human Resources was also present to present to staff on their deferred compensation and options. I'm happy to report that ORS is one of the top organizations within the city based on participation within deferred compensation. Not too shocking, being that all of our people are retirement professionals. We had our annual summer picnic on Friday, June 5th. Pleased to share that our very own Sherelle received the 2026 Directors Award. Sherelle was selected in recognition of her diligence and her consistent willingness to go beyond her day-to-day responsibilities and her meaningful contributions to several important administrative team initiatives, including all of the complicated and long ADA compliance work that we completed in the past 12 months, and as well as a resolution project. So well-deserved. And then just a reminder for members, ORS is closed this Friday, June 19th, for the Juneteenth holiday, as well as July 3rd, in observance of our nation's 250th celebration of its independence. With that, I will take any questions.
Thank you. Are there any questions from trustees? Any public comment? No comment. All right. Well, thank you very much, Mr. Flynn. Move on to item 5B, oral update from our City Council liaison, Vice Mayor Foley.
Good afternoon, or no, not afternoon, not yet anyway.
Nearly there.
We did, as reported, we did approve the budget last Tuesday and overcame a $50 million deficit. We are not out of the woods for next year as we project another deficit, unfortunately, but I want to thank the voters for passing the transit occupancy tax increase that affects individuals who are staying at our hotels primarily. That really helped us from not having to implement any more draconian cuts that we had in the initial budget. So I want to thank you all for that, for whoever voted in support of that. A couple of things. We are in the middle. One key thing to keep in mind about our budget is that we were able to retain the majority of our staffing positions without reducing the majority of our services. There were staff positions that were eliminated. Of those eliminations, there were less than 10 staff people who were in those seats. They will all be reassigned. So we're not losing any staff members. They will be reassigned. We are realigning some of our positions. We did reach successful negotiations with several of our bargaining units, which were all approved on Tuesday. We still have our two largest bargaining units that were close but not there yet, unless they were successful yesterday, and I haven't heard one way or the other. And that the two we're still working with is MEF and IFPTA. Another thing to note is that I know while you have had hybrid meetings all along, we have not. We stopped accepting public comment virtually a couple of years ago, but as of June 8th of this month, we implemented hybrid meetings once again. State law required that we do so as of July 1st, but we wanted to implement it in time for the public hearing on the budget, which we did. So we had public comment, both virtual and in person, last Monday, and have gone forward. Part of the recommendations that we approve for our hybrid is that all public comment is limited to 1 minute. That allows us to actually move the meeting forward a little quickly. Still, 1 minute is sufficient time for an individual to state their position and what their thoughts are. And for those who think 1 minute is enough, you should time yourself speaking for 1 minute and see how long that actually really is. That's the other thing coming up is the July break. We have no council meetings, which means many of us will not be in the office. Our council offices are open, but services tend to be slower during July, or responses are slower because our staffs are that's when they take their vacations too. You may have heard this thing called World Cup is big and active in the city of San Jose. It's really exciting, brought a lot of people into to the city. A couple of the teams are staying with us. Paraguay is staying downtown. I think another country is too, but I forget which the other country is. Paraguay actually is practicing at San Jose State. That's exciting. If you're a World Cup fan, or even if you're not a World Cup fan, there's a lot of energy down at San Pedro Square. The Quakes have hosted the watch parties. The street has been closed off since COVID, and it's a wonderful place. Quakes have 2 big screens set up on either side. You can go down and experience those watch games along with everyone else. It's an exciting time. I also want to mention that I am hosting, along with District 10 Councilmember George Casey, a watch party on July 3rd. That will be at the Almaden Lake Park. It's an all-day event. We're hosting 3 matches that will be knockout matches. So once, we don't know who they'll be because they have to get to that level before we know who's competing, but it should be an all-day exciting event with 3 matches, food trucks, a lot of activities for kids. Put it down on your calendar since you're all not working. July 3rd, you can come down to Almaden Lakes. It'll be a good time, and I'll see you in the morning. And that's, I think, all that I have that I need to talk about, except this was my last and final budget, and I'm very excited about that.
Hey, thank you very much, Vice Mayor. Are there any questions from trustees?
It's a nice job on the budget.
Thank you. Unanimous. This is exciting.
Yeah.
Okay, how often does that happen?
Not very.
No questions from trustees? Any public comment on this item? There is none, so thank you very much. We will proceed to 5D, discussion action on the Vision 31 ORS Action Plan. And I believe Mr. Flynn is going to introduce this one.
Yes, just give me a moment so I can share
Sure.
my screen. Okay. So at our March meetings, the boards approved a consolidated mission statement, and we created a vision statement for ORS as well as the 5 core values. At that meeting, we also approved 6 strategic themes supported by 6 goals and 21 objectives over that with the goal of being formulated in the next 5 years. The role of the administration now is to put together an administrative action plan that brings those goals and objectives to life. So what's being presented to you today is 35 strategic initiatives that would be accomplished or be put in progress between fiscal year 27 and fiscal year 31. On the agenda today and in front of you are this presentation. There's a Vision 31 narrative document. There is a list of these 35 strategic initiatives broken out by goal and objective that very clearly states what the initiative is, when it's due to start within fiscal year, when it's due to end, what are our definitions of success, and then any notes that we compiled while we were creating this. Also on the agenda, as well as printed out for you, are some what I just call desk references, color-coded, of course, by the strategic themes. One is just it's organized by theme, and then the other one, for those of you who are more project manager, engineering focused, a Gantt chart that kind of lays out each of the initiatives over time. And I found that's extremely useful because, as you can imagine, some of these initiatives build upon each other, right? So you can't do step 3 until step 1 and step 2 are done. And so kind of laying that out and seeing how it evolves over time. Some of the themes in the Vision 31, where we envision what ORS will be like in 5 years, is we're trying to say what will the members know and expect, and then what will we know more about our members. In the themes here, we spend a little bit of time getting some more broader input from our membership, not just as part of the strategic plan for efficiency, and as you can imagine, we did do outreach to membership, but we focused on the union executive teams and the retiree association executive boards to provide that input, but really reaching out to our members in some way that we can identify how they want us to communicate with them, where they want us to communicate with them, and what are some of the things that they want from ORS, right? We've heard some public comments about wanting withholding capabilities on the Member Direct website. That's exactly the type of feedback that we want to hear from the members. And then that feeds then some of the strategic initiatives down the road, so that we know where, we live in a limited budget, we live in a limited headcount, so that we can focus our energies where we get the most value, not to John Flynn, but to the membership. We want to make sure that we're building an organization that can sustain this work, right? 35 strategic initiatives sounds, maybe, I think the word I used was ambitious when we were discussing this internally. But I think we want to make sure that if we're going to start something and it's going to add value, that we can sustain it, right? And that's not just number of staff, but it is competitive compensation, which we spent some time talking today. It's the structure of the organization, and that we want to make sure that we're investing in our quality staff, so that they feel like we're investing in them, as well as that they can continue to excel in the jobs that we put in front of them. Growing up on the technology side of organizations, I've seen many initiatives that we do technology for the sake of saying we're doing technology. I remember when iPads were the new thing, and all the school districts in New Jersey were rolling out iPad programs. And the question was why? And nobody could tell you why, other than they were rolling out the iPad program. So we want to make sure we're not focusing from technology to then solve a business problem. We want to know what the business problems are, and then determine what's the best way to do that, whether that's technology, people, systems, what have you. And then lastly, I think my experience with this board and ORS's boards is that we have a very good governance structure, but it requires watering and pruning. And so, we've already put in place a review process within our governance committees and through the boards. But we want to make sure that that is getting the attention that it needs. But it's not just governance; it's also board education. We have a few potential vacancies across the two boards at the end of this end of this calendar year. We want to make sure we have a good onboarding process, as well as continuing board education on the topics that make the most sense. So the 35 strategic initiatives, as it breaks down across the six themes, you can see that they're spread across the organization, but you can see that there's a focus on the organizational capacity, talent, and succession. But I think the thought out process is there to support all the different areas of the strategic plan. Now, I haven't displayed the different areas of the strategic plan as part of this presentation, because it's too immense. But I will take questions. But I just want to say that, to kind of break down the initiatives, while 35 sounds like a lot, some are already in progress, right? So you heard some mention today the asset liability study. Well, we met with Chiron and Makita a few weeks ago to kind of kick that process off, put together the timeline that Jay had presented earlier today. So, that's in process. Our investment compensation study, that's been in process for over 6 months. And now will likely go a little bit further. So there are some things already going. Our budget policy review, there's an item on the agenda today to establish an ad hoc committee. So these things are already moving. And then there are some things that are easier to focus on, so now that we have our benefits program manager and our DCIO positions approved, well, now just onboarding them and integrating them into the organization structure. So not necessarily something that's a heavy lift, but something that we have to do and is super important. And then we have some focus on our capacity and the capabilities of the organization. We've talked a little bit about what we want to do from a communication program standpoint, right? We heard a lot from our membership that they want more engagement and they want more education. And we need to be able to build the capacity within the organization to deliver on that, because right now we have an outsourced communication model. And we also outsource the majority of our legal support, all of our legal support. And so taking a look at that is also something that we've talked about when we were going through the procurement processes last year. So, bringing some of those assessments to place to set up so that we can then achieve some of the out-year goals based on the capacity and the model that we choose. I think possibly the biggest component is the membership survey, because that becomes foundational for many of our other strategic initiatives, like our member portal priorities, our communications program, our member engagement and education, but then also the service delivery metrics that I'd like to build as part of the organization. What are the services that we're providing, and what can the members expect from service delivery? So I'm happy to go into any questions that you have about any of the specific items. If not, I'm going to switch, because this is a presentation to you. The next item is an action, and that action is to approve the fiscal 27 work plan. And so does anybody have any specific questions about any of the work plan?
I do.
Trustee
I think that this reminds me of the Built to Last recommendations, where they talk about setting big, hairy, audacious goals. I think that's really great. I have concerns about budget constraints, both from a budget perspective as well as a staffing perspective, in terms of being able to get this done. And I think if we approve it, I feel like we don't necessarily have the thought behind how we're actually going to make this work plan happen. So that's sort of my concern there. And one of the things so that's one thing. I just wanted to express that I think it's a great goal. I feel that we have some real constraints, and I'd love to hear more about how we're going to address those constraints.
Sure.
Yeah. So so that's one thing. The second thing is that we talked about the membership voice survey, and I know it's really important. And the message says we have to get this started right away, but I don't know, without knowing more about it, how we can really approve getting it started right away. And maybe that's not what you're talking about. But anyway, those are my two thoughts.
Sure. So I think. I'm going to, for those of you who've been on the board for a little bit or been with the city for a little bit, you'll know who Julie Jennings is. Yeah. And I remember she questioned me about I think it was the procurement, of one of the big procurements that we did last year. And I had set out a timeline, and she said, do you really think you can accomplish that in the timeline? And I said, well, I can tell you for sure, if I don't set that as the timeline, I won't be able to. And so I think this is an ambitious plan, from everything that we do, even including the stuff that's just analysis, that then I need to come back to the boards and ask for approval to create a contract, to create a position, to change a budget, or next year's budget, or the budget thereafter. But all of those will come back. So by approving, this plan, the action plan is not for approval. The work plan is. But anything in there that's going to require a budget change or a personnel change will come back to the boards for approval. So the approval of the work plan doesn't necessarily say that John can go do whatever he wants to accomplish these initiatives. So I do think, so two of the initiatives that I mentioned already, which was the communications and the legal services, the work plan is to do an analysis and then to come back to the boards to present recommendations, right? And if the recommendations of the boards are that some of the communication programs are not worth investing in, then we can shift. We'll have to shift gears at that time. But I think, and then also consequently, police and fire have to also approve those, and then we need to bring them to the city council budget process, right? And so, any hiccups in any of those ways will require a change in plan. And so I think, I don't think we should not try to do it, because it might be hard. I think it's important that we push forward, so that we can hear what the members want. Based on what they want and need, we can then determine, I can then make a recommendation of what's the best way to push forward, including if there are any budget impacts, including if there are any staffing adjustments that would need to be made. Sorry, what was the second question?
We are really talking about understanding how we could get the membership force survey done really quickly. It says the details say it has to be done right away. We're not going to be back till August. Things have to be structured. I don't know. I just don't. If I look at the work plan, which I glanced at, I can't say I did it total, but it just felt to me like there's an awful lot. Yeah. That assumes that we're going to start now, and it feels like we have a board and staffing and possible money constraints. So I'm just wondering if this is.
So with the approval of the board of the work plan, unless there's a budgetary impact, or unless there's a staffing impact, or unless there's a contract need, I actually don't need to come back to the board for approval to do the work. We'll do the work. We'll just do the work. So, so as an example, I don't believe in order to execute a survey, we will need any of those from the board. We have survey software that we use. We have the ability to create some of that, and it's going to be one of my main area of focus in order to accomplish. So.
Okay.
Trustee Linder.
What I like about this is it gives focus to the energy. And what I've seen in organizations I've worked with is a lot of energy unfocused doesn't produce much. And I'm, having done interim work as city manager, as well as doing, working in big cities like here and so on, to have this kind of focus is useful, particularly when you have constraints. Because you can burn enormous amounts of energy, and people get totally frustrated because where are we going anyway? I'm dealing with the situation right now in the city that's exactly what it is. Right. Where are we going? Everybody's busy. We're all, we have deficits. We have this and that. Where are we going? And nobody's answering that question. What I like about this, and we may not make it, but I like that we have it laid out we have it where we're going, and we have a focus for the people who are here. And when it's accomplished, we have some very cool recognition. And we could say, well, what have you done with your time here? Well, here are some of the things I've done. So that's why I like what's in front of me, even though it's daunting. I'd rather do that than have people just burn time.
Right. Well, focus to the energy. I've coined that as the Mark Linder phrase. I plan on using that. Thank you.
Okay. Any other trustee comments?
All right. I have one or two more slides, if
Okay.
unless you. So, nope. There we go. So for the work plan, we are focusing on 20 active initiatives in fiscal year 27. Against we have 7 that are initiatives that are listed in the plan, but is work that we're already doing, really more focused on governance and fiduciary duties, right? Some of the stuff that this board is already doing very well will continue, right? Our quarterly reporting on our investments, our actuarial work that we do every year, with just some enhancements to that. But some of the 5 priority initiatives that I've identified for the work plan for fiscal year 27 is the asset liability study, which you heard from Jay earlier today. We've already talked about the membership voice survey, which becomes foundational for a few other items. And then taking a look at the communication and the legal function and determining if, what's the best longer term model for each of those. And then also later on today's agenda, the budget policy, the ad hoc budget committee to review the budget policy. I think Trustee Abbott is keenly aware that some of these, you can't do something for nothing, and so there will be impacts in some way. We want to make sure that we've got a good policy in place that supports the process, make sure that the board has the right level of authority and has the right level of delegation to the right people. So I think that budget policy is going to be an important step, an early phase of the initiatives. Okay, so some of the things we're watching, I think we've already discussed earlier today, the legislative environment, not just at the state level, but the federal level, the state level, and the local level. Cases such as the Lucera case, which we mentioned earlier today, can have a big impact on our environment here, our landscape. Plan execution, if some of these run one into the other, and so if one gets delayed, the next one will get delayed. And we want to make sure that one of the reasons why we did the Gantt chart layout was to make sure that we had that visually understanding of how that works and making sure that the actual core sets of initiatives in the Excel document were written appropriately and not everything was starting all at the same time as it might have been when we first constructed it. And then the last thing is the known and unknown turnovers, right? Losing Sandra as our benefits division manager is going to have a tremendous impact on our organization. She has the respect of the staff and the executive team because of the great work she does. And so, that replacement could cause delays. But what I'll say is we're leaning into that. We've already started doing some of the planning on the member direct portal enhancements, working with our vendor to understand what the capabilities were. So, we're leaning in knowing that that's happening, as well as putting some transition in place based on another agenda item today in order to make sure that we can do a proper transition and appropriate succession planning. I think what's important is just the accountability and the governance of this plan, right? So, we want to make sure that I want to make sure that I'm keeping the boards up to date, but I also want to make sure that all of our stakeholders have the ability to stay up to date, including our membership. So my plan is to develop a quarterly progress report that will be a written report that will be included on the agenda. So it won't take up any more agenda time unless somebody wants to ask some questions. We'll go through the annual work plan process, which we're going to start with the next agenda item, where we'll formally approve the work plan. That'll be the chance to say, this is what we're able to accomplish in the past 12 months. Here's where I think we need to go in the next 12 months. And all of that then gets baked into the executive performance evaluation, right? So I've talked about this a few times, definitely in the governance committee when we're talking about the CEO performance evaluation. We want to make sure that the goals that we're setting are embedded into the executive performance evaluation so that we have something that is A, known, and B, valuable to the organization. But also important is that then those goals and objectives can be included in along the organization down the chain. So it's not, it's not just me, but it's Barbara, it's Sandra, and so on and so forth down the organization where they have meaningful components of the strategic plan. And then, of course, if there's anything that changes, anything that breaks, we won't wait for a written report. We'll bring that to the board as appropriate, as needed, if something meaningful is going to change. The footnote here just says what I've already said, but again, the plan is ambitious. It is likely that some of these initiatives will take longer than we planned, but we want to make sure that there's a structure in place to keep everybody informed, and that as the landscape, we can only build the plan based on the landscape that we can see from where we're sitting and standing today. As that landscape changes or unfolds, we will likely have to make some changes, and we'll do that openly and transparently. Yeah, okay. I think that's it for the Vision 31. If you have any questions on that, or we can go right to the work plan.
Okay. Are there any questions from trustees? I'll just comment that I'm very excited about this strategic plan. I think it's broad in scope. Maybe it's ambitious, maybe it's too ambitious. We will find out. But I feel like really for the first time since I've been on the board, we're not simply drifting towards the next crisis that we are not anticipating, and that we're taking proactive action to figure out where the landmines are.
Yeah, well said.
So I appreciate that.
Thank you.
I believe as it is an agenda item, I do have to ask for public comment on the agenda item, even if we have no action. And indeed, there is public comment.
Of course.
So please introduce the commenter.
We have a public comment from Mr. Brad Imamura. Mr. Imamura, you have 2 minutes to speak. Please unmute yourself. Your time starts now.
Thank you.
Thank you. With regard to, well, first of all, I want to ad nauseum identify myself. I'm not a member of the Retiree Association, as a majority of the retirees are not members of the Retiree Association. And you have a representative there who is entitled retiree representative, but that trustee represents the Retiree Association. Correct? And I'd like to see a better outreach for those people who don't attend those closed meetings. And you have presentations from, I think the last one you had mentioned something about Mr. Kwong had went there and discussed the investment, approach of the retirement fund. So most of us who are not members of that association do not attend those meetings. So how do we get access to that? So I would like to see this plan be doing a better outreach to those retirees who are not connected with that association. I know it's convenient for you to go to one association and you say, well, I did my duty and I reached out to retirees, but they're not reaching the majority of the retirees. And I've mentioned this ad nauseum for a year. So, and until we get someone who actually represents all retirees, and again, my invitation goes out to all you trustees. I've met with a couple of the, at least 3 of the trustees, and I appreciate that. They took the time to meet with me one-on-one, and I would like to meet with the outside members. And I know most of you probably don't even live in the city of San Jose, so you have no connection to the city of San Jose. But you like to sit on these boards that, you end up fixing. Like me, I'm a taxpayer. I'm a stakeholder. For you that don't live in San Jose, you don't have any stake in the city, but yet you come on this board.
Okay, thank you. I'd just like to remind everyone that as trustees, we all have a fiduciary duty to the members of the plan, and I believe we all carry that fiduciary duty close to our hearts.
That's our main duty.
I think a relevant point is the efforts to outreach to non-members of the SJ RIA. So hopefully we do have a plan for that, and that will be part of this outreach program in terms of getting the voice of the members and all members.
I think exactly what Mr. Imamura is referencing is what we're attempting to accomplish, which is an outreach to all members, not just retirees, but active members, new retirees, old retirees, retirees that live in the state, retirees that don't live in the state, so that we can understand exactly how they want to be engaged with. As you can imagine, engaging with a member who is brand new, 25 years old, a brand new member, wants to be engaged with very differently than somebody who is 80 years old and has been collecting for a number of years already. And so part of the thought process around the survey is also to striate it such that we can get feedback from different groups to understand what each group wants, because again, the communication to even just an active versus a retiree would be very different, and understand that. So yes, that's the exact type of feedback we're looking for, and based on where our members want us to communicate and how they want us to communicate, we will look to build a program and a communication function that can support that.
Great. All right, so no action required on 5D. We can move forward to 5E, which is discussion and action on the 2027 Annual Strategic Work Plan.
Sure, just give me one moment. I apologize, I don't know how to change my tab here when Zoom is blocking it. Okay, so the fiscal year 27 annual work plan, as I mentioned, is 20 different initiatives. I think it's important to note that we're starting initiatives in each of the themed areas of your strategic plan. Again, the heavy focus is going to be on some of the foundational components. I'm not going to repeat myself other than to say that we're as part of the work plan, we've broken it down by the different areas. We've highlighted the focus areas, and then we also have some anticipated dates of completion. In the detailed plan, we also lay out what the success criteria is for each of these items, and when I provide the written report to the board, it's not fully developed yet, but I plan to give you a narrative on all the good stuff that we've done in the previous quarter, give you a status that's easy to refer to, like a red, green, and blue. Red, yellow, and green. What we think is on target, what is at risk, what we need to shift, and then the explanations of why something is in the status that it is, and then any hurdles or expectations that we know at that particular time, planning to bring to the board this request for X, Y, and Z. There's a couple of these items that are somewhat time sensitive, so the budget policy work that we need to, so the city's budget policy starts in January behind the scenes, where we're submitting personnel requests to the city. So we really need by the December board meetings to wrap up anything that will impact personnel budget decisions for the following year, as well as any budget policy updates that we want to make. So some of these items have some criticality that if we don't do it by here, well, then we got to wait a whole nother year. And so, again, we'll do what we can to bring those together and build a plan that will get them completed in the time that we need it. I'm happy to talk about any of the prioritization, any of the timing, why did we choose this over that, or any other questions that you might have.
So what action do we need to take today?
You're just approving the work plan.
So I move we approve the work plan.
Okay. Is there a second for that motion?
I'll second.
Okay, we have a motion from trustee Linda, a second from trustee Abbott. I just have one quick question, just a definitional thing.
Sure.
And that is adopt a formal funding policy. Is that simply a formalized version of what we are already doing in terms of the whole Chiron sequence of looking at the funded status every year and discount rates and what our assumptions are for the next year, economic growth, inflation, et cetera?
The board approves the valuation assumptions every year, and part of that is the amortization that comes with all the different components of the valuation. And so typically, we see that as a separate document rather than embedded in the valuation report. Not that it couldn't change every year, but typically that's a standalone document. And so we're suggesting, based on some conversations with Chiron, that we break that out, make it a standalone policy for the boards. As well as, I know in the past there have been some discussions around pension obligation bonds, amortization, and the impacts of that. That's been an area that I'm not sure was ever quite finalized, so that'd be another area that we could consider adding within this policy, but that's really, we have the policy, it's just embedded in the valuation reports now rather than a standalone document.
So it's more of an aggregation and memorialization of, correct, as opposed to new work and a new effort to create something new.
Yeah, and to bring, no different than the review of all of our other policies, also brings maybe an added focus to some of the things that don't change very often, like the amortization schedule for gains and losses in the investments, gives the board a new set, a recent set of review over that.
Okay, great. Any other trustee questions or comments on the motion to accept? Is there any public comment? No comment. So we can vote. All in favor? All opposed? Passes unanimously. Great. On to 5F. Discussion and action to approve 1 full-time oversight benefits division manager position. And I believe this is related to our succession planning.
Correct. So just as a reminder, as part of this last budget cycle, the board's approved previously they approved an overstrength benefits program manager, and then as part of the budget process, we just got approved of a permanent benefits program manager. For many reasons, over ownership of the disability program and some of the technology enhancements that we're planning for, but also for a succession planning within benefits, because the jump from senior analyst to division manager is too far of a jump. And if we look at our last, I think it was 4 hires into the position, they all came from outside of ORS. And so we created a succession planning component so that we will have the option to have somebody internally that could be considered for that position. But that is going to help the next generation of the benefits division manager, not the current generation. So we're requesting an overstrength position, the approval of an overstrength position, so that we can recommend it to the through the budgeting, through the approval process of the city. This will align with Sandra's retirement on January 2nd, 2027. So this is a temporary request based on an event that's happening within ORS. And what this technically will allow us to do, so the city doesn't allow us to recruit for a position that isn't vacant. So we would have to wait for Sandra to leave on January 2nd, and then we could start recruiting, which would leave a huge gap in the organization. So the proposal is we create this overstrength position. Sandra is actually technically placed in that overstrength position, which then allows us to recruit for a permanent permanent benefits division manager. And that's why it's temporary.
Okay. Right, sounds very sound. Any questions from trustees? Anyone would care to formulate a motion?
Actually, one quick question.
Okay, sure.
The memo says that the estimated cost is I see $2 months. I see 80,000 and 123,000. Can you kind of clarify what the difference?
Oh, sure. I think 80,000 is the salary. 123.5 is the loaded cost. And I think the 123 assumes that person takes the position starting September 1st, just to give time for the recruitment process and the onboarding.
Okay. And as you said, the cost is covered by vacancy savings, right?
We believe that we're going to be able to cover the costs based on the current sets of vacancies that we have within the organization. If by some chance something changes, what I'm committing here is that we'll come mid-fiscal year to the boards to discuss it. But I do think we're going to be able to cover that. We have, as I went through in my announcement, my oral update, we have a number of vacancies, as well as the program manager that is due to start Monday, or the position starts Monday, and the DCIO, which also starts Monday. Those start ticking for vacancy benefit. So,
thank you.
Sure.
Okay. Any other questions from trustees?
And also important is that cost is split between the two boards.
Yeah. Until we get to the budget review.
I was going to say currently.
for the moment. Anyone like to formulate a motion? Anyone at all?
I'll move that we support the overstrength manager position, and the way you're doing it sounds really sound, so that we have continuity of expertise as well as being able to bring someone on board.
Mm-hmm.
It is a really critical position for the retirement system.
Okay, so we have a motion from trustee Abbott. Is there a second?
I'll second.
Second from trustee Nakagawa. Before I ask for any further trustee comment, is there any public comment on this motion? There's no comment. Is there any trustee comment on this motion? Seeing none, we can vote. All in favor? All opposed? Passes unanimously. Thank you. Item 5G, discussion action on the just mentioned ad hoc budget committee. To review allocation, this is to assign 2 members of our board to work with 2 members of the police and fire board. I presume they assigned 2 members yesterday. Would you like to share who they assigned to this task? Would that prejudice the vote?
It's public, so I believe it was.
It is public.
Trustee Flicker and Trustee Votto. Thank you.
Okay, very good. So I don't know if there's two things required. One is to authorize the ad hoc budget committee, and the second is to make an assignment. Or
so to create the committee, it needs to be for a defined purpose and a defined duration.
Mm-hmm.
The purpose is pretty clear. The duration is till the completion of the next budget cycle through the city's process.
Mm-hmm.
Just in case when we make budget changes. If we make budget changes here, there could be some ripple effects through to the city, and just so that we have that committee in place in case questions come up that we want to be able to meet with quickly to get answers and recommendations.
Okay.
So,
but I'm just wondering, do we need 2 separate votes to implement and then to assign?
I don't think it's too. Yeah.
We'll do it omnibus. Okay. So with that, I will accept volunteers to.
I'll volunteer.
Okay, we have Trustee Abbott. Do we have any other eager volunteers? Trustee Linder, wow, I love it when this happens. I don't know if anyone else wants to volunteer or to volunteer anybody else.
Drop off if somebody else wants to volunteer.
Okay. Don't give that option.
It's of interest to me.
Okay, so we have strong interest from 2 trustees. Thank you so much. I know you all have a lot of other committee work, so I appreciate that you're stepping forward for this. So with that, I will entertain a motion to create the ad hoc committee and assign trustees Linder and Abbott to it. Do we have such a motion? We have a motion from trustee Chi. Do we have a second?
I'll second.
We have a second from trustee Nakagawa. Is there any public comment on this agenda item? There is no comment. Is there any trustee comment or discussion? Seeing none, we can vote. All in favor? All opposed? Passes unanimously. Okay, we're into the sixes. 6-1, Investment Committee. Looks like there has not been a recent meeting.
I think we got a little preview of at least what portion of the agenda will be for
Okay.
the
Yeah.
August board meeting.
Okay.
Sorry, committee meeting.
Right, that should be interesting. No other action required. Audit and Risk Committee. Trustee Linder, we did have a fairly extensive
We did.
presentation.
Let me
and-
kind of outline here.
Okay,
You have a lot of attachments. Some of these attachments, however, show up later on in this agenda where we actually need action. So you can look at the attachments, and these are the issues that are in there that the audit, we had the joint meeting. One of those things that I like, actually, is a joint meeting, even though they're a little convoluted, because we don't have to go back and forth, we can get it done. All these things have had committee work. There are recommendations going forward, particularly under 6.2C, D, and E. These actions are the audit plan for our outside auditors, and I believe, John, we have them presenting some of their plans.
They're online
They're
today,
online.
typically.
There is a plan that was looked at by the committee that's in your attachments. We also have an amendment to the internal auditors, the Baker Tilly, and we have the, even more interesting is their internal audit plan for the coming fiscal year. And those are attached, and people are available to answer questions from these two organizations. But I think the first thing is, you have any questions on all the other stuff? And then we will have to do a receive and file of the minutes.
okay. Any questions from trustees? Any public comment on this agenda item? There is none. Okay, so no action is required on 6.2A. 6.2B, we can receive and file.
So we do need action on C.
6.2C, which is discussion action on the external audit plan from MGO.
Right.
So I'll introduce
Okay.
that.
Yeah.
So MGO presented their audit plan to the audit committee. Audit committee reviewed that in detail, asked some questions. There was a presentation. The audit committee is recommending to the boards the acceptance of this fiscal year plan. We have MGO on the line if you have any detailed questions. Otherwise, we're ready.
We're ready to approve. Are there any questions from trustees? If not, I'll entertain a motion to accept their action plan.
So moved, Mr. Chair.
We have a motion from trustee Linda. Do we have a second?
Yeah, I'll second.
Second from trustee Chandra. Is there any public comment on this agenda item? There is none. Is there any trustee comment or discussion on the motion? There is none, so we can vote. All in favor? All opposed? On to 6.2D, discussion and action to approve a First Amendment to the agreement with Baker Tilly for internal audit consulting services. Again,
Sure, yeah,
Mr.
that's
Flynn.
me. So just as a reminder, Baker Tilly is the consultant that we hired to be our internal audit provider. The boards enter into agreements with Baker Tilly in December 2025 to establish a comprehensive internal audit function, including the risk assessment, 5-year internal audit plans, annual audit engagements, reporting to the audit committees and the board, and monitoring of remediation efforts. The amendment clarifies deliverables, payment milestones, and better aligns the work with appropriate tasks, and creates a process for administrative work to be worked on throughout the engagement. I think the most important thing is that this is just a realignment of work among the tasks, creating an administrative task, and does not change the not to exceed amount for the engagement.
Okay. Any trustee questions on this agenda item?
Yeah, I believe we have 2 actions that we need to take, right?
This is just one action.
Okay.
For D.
For D, correct.
Okay, I'll make a motion to approve that.
Okay, that's what I was waiting for.
Yep.
Motion from trustee Chandra, second from trustee Linder. Any public comment? There's no comment. Any trustee comment? We can vote. All in favor? All opposed? On to 6.2E, which is discussion action on the proposed internal audit plan.
Right, the actual.
Okay, I'll just ask the admin team to, oh, there's Stacy, if you could make sure she can present and speak.
She's good to go. She's all set.
Okay, great. Stacy, can you hear us?
Yes, I can.
Okay, great, thank you.
Yes,
I'm
so
just
this,
going to share my PowerPoint slide that I've got here.
Mm-hmm.
Okay, great. So yes, good afternoon, Chair and board members. I'm going to be presenting the results of our agency-wide risk assessment and our proposed fiscal year 27 internal audit plan for ORS. The risk assessment is what really serves as the foundation for the 5-year internal audit roadmap. So I'm going to go through and briefly summarize the approach, highlight the key results, and walk through the proposed projects for fiscal year 27. I'll begin with just some background on the engagement and our risk assessment methodology, and then we'll review overall results and explain how those results were used to develop the 5-year audit plan. And then lastly, I'll discuss the projects that we are proposing for the fiscal year and conclude with any questions from the board. And you also should have received both the summary memorandum as well as the full risk assessment report in advance. So I am going to keep my remarks at a high level and reserve most of the time for discussion. As part of our duties as the internal auditor, we perform this agency-wide risk assessment to inform and develop that 5-year audit plan. And the purpose of the assessment is to identify the areas that present the greatest risk to the organization and to help ensure that, with the audit resources and the time that we have, that we're focusing on those areas that can provide the most value. So in the context of audit planning, risk refers to the possibility that an event or a condition could impact ORS's ability to achieve its objectives. So our process begins with developing an audit universe, which is essentially just an inventory of the major functions and activities performed across the organization. Risks are then identified and evaluated within each one of those functional areas. And our assessment was completed in 4 phases. So first, that includes planning activities, interviews with key stakeholders, audit committee members, management, and staff, and then gathering and reviewing supporting information, prior audit reports, strategic documents, budgets, financials, organizational information, things like that. And then we analyze the identified risk by evaluating both the likelihood of a risk occurring and the potential impact if it were to occur. So those 2 factors are multiplied and combined to create an overall risk score for each functional area. And then lastly, the results are documented and used to develop those proposed audit areas, again, with kind of, there's a few factors that go into that, but ultimately trying to focus on the highest risk areas. Within the audit universe, there are 46 identified auditable functional areas. And this table summarizes those areas and their associated risk ratings. So risks, again, based on likelihood times the impact of those related risks. That's how we get to the risk scores. If you look in the risk assessment report itself, within the appendices, we do have tables which show, the scale that we're using, both for impact and for likelihood. Those are 1 through 5 each, and that's what gives us that final risk score for each of those. So within the results, again, like I said, once we get the final risk score, we can prioritize the list from highest to lowest to then break it out between high, medium, and low risk functional areas. So you'll see the lower risk items here, higher risk items in red at the top. And that's how we, determine sort of the roadmap there. And I would say, while the assessment considers risks across the entire organization, our recommendation for fiscal year 27 focuses on the areas that management and stakeholders identified as the most significant and timely risks facing ORS, and again, related to those that fell in that high risk bucket. So for fiscal year 27, we are proposing 1 advisory engagement and 1 internal audit engagement. So the first one is focused on 1099 reporting. During the risk assessment process, management had identified the upcoming IRS reporting changes as one of the most immediate operational risks facing the organization. So our engagement here is going to evaluate the design and effectiveness of controls surrounding the reporting process. That includes the implementation of the third-party system, looking at data accuracy, filing requirements, and regulatory compliance. And the second project is an audit of investment manager reconciliation and the related investment accounting controls. So that audit will focus on controls over investment valuation and financial reporting, accuracy and completeness of information received from investment managers, timeliness of the close process, and the identification and resolution of variances. So again, together, these projects address the key risks identified through the assessment process and provide a balanced focus on both the regulatory compliance and the financial reporting aspects. So that concludes my presentation. As I said, those proposed audits really reflect the results of the risk assessment and how we see the most value within this first year to ensure that we're focusing our resources in the right place. I'd be happy to answer any questions from the board. Thank you.
Great, thank you. Are there any trustee questions?
I have one.
Trustee Abbott?
I just noticed that cybersecurity and data protection had a slightly higher risk score than the choice of us doing the other one we chose. So is there a reason why we would pick something with a lower score rather than a higher score? So why would we pick?
I apologize that the sound is cutting out a little bit, but I did catch what your question was. Cybersecurity being a high item. So there are a few factors that go into what we determine to include on the proposed audit plan. So it's not just going from highest to lowest, it's considering a few other things. So one, yes, is the risk score that we get from the risk assessment process. The second is, where can we add the most value? So in doing an audit or an advisory project, what will provide the most value? Another item is, consideration of what has been looked at previously in other audits and prior audits. how recently have those areas been evaluated? So specifically as it relates to cybersecurity, that is something that is being reviewed and audited externally. So while we did feel that that is a high risk area, that there were kind of other audit activities and monitoring and oversight within that specific functional area that sort of rose our recommendation and our priority on the investment side a little bit higher.
Thank you.
Any other trustee questions?
Yes.
Trustee Nakagawa, please.
Thank you. For the risk score, can you tell us what the range is?
Sure. So we, as I mentioned, we've got kind of two factors that we are looking at. So one is the impact. Again, if these risks were to happen, what would be the impact on the organization? That is 5 separate scores, 1 through 5, 1 being negligible, 2 being low, 3 being medium, 4 being high, and 5 being critical. And again, in the risk assessment report, we kind of lay out sort of definitions for each of those, but essentially 1 is the lowest, 5 is the highest, and then we look at likelihood. So if, not considering current controls, current practices, but just the inherent risk that exists, what is the likelihood of those risks happening? And again, that's a 5-point scale. 1 is rare, 2 unlikely, 3 possible, 4 likely, and 5 is almost certain. And then we take that impact times the likelihood rating, and that gives us our final risk score. So again, if you're looking at a 20, 1 of those was rated a 4, 1 of those was rated a 5, most likely to give us that 20 risk score.
Okay. Thank you. And has this type of audit been done on comparator agencies? And if so, can you share kind of where we're at versus these other agencies in terms of like total number of, I guess, functions that are in the red?
So, yes, so I do want to clarify that the risk scores that you're seeing here, that is not indicating that the highest risk area is something where there's gaps or issues in place. This is just considering inherently for each of these functional areas and what's involved there, what is the risk level of that functional area. And so we just use that as a way to understand, okay, these are high risk areas, so it's probably going to be most valuable for us to focus on some of those higher risk areas within our audits. And then whenever we conduct an audit, that's where we'll understand, okay, what is the current state of things? How are the operations doing? Do we have strong controls in place? Are we effectively mitigating the risks that do exist within these areas?
Okay, so to clarify, like with 1099R reporting, like the system could be functioning perfectly, but the risk score would still remain at 20.
That's correct.
Okay, thanks for that. Thank you.
Any other questions from trustees? I've got a couple of quick questions. I noticed that all of the ones in the red zone, either we have a proposed audit plan date or they were done recently, with one exception, and that's the ACFA requirements. So it's neither been done recently nor do we plan to do it in the future. Any comments?
So again, like I said, these are taking into consideration, what other sort of oversight activities or audits, reviews are in place. And so whenever we're thinking through our audit plan, a piece of that is, okay, if there is ongoing auditing or related activities that are happening, then from a value standpoint, maybe it's less of a priority for us to try and focus our internal audit efforts there. And I do want to mention, though, even though it's not listed as a kind of proposed audit at this point, on an annual basis, this risk assessment process is going to be updated. So as things change, those risk scores can change, and the sort of proposed audits or audit areas per fiscal year could also change.
And then almost all of these are some type of functional process that is going to be audited, but one is asset allocation. So I'm not quite sure what you're auditing there, or you're auditing our compliance, our implementation compliance with our stated asset allocation. I'm not quite sure if asset allocation can be audited.
So everything that's listed here is more so related to a key functional area. So if we're kind of thinking about the key functions within each of the divisions, so you'll see in the first column here, these are the divisions, and these are the key functions of those divisions. So this isn't representing audits themselves. So when we proposed an audit, it may be over the entire functional area. It may be over a specific subject matter within that area. But for the purpose of the risk assessment and what you're seeing here, this is just the key functions within each of those divisions. So this is just a way for us to break it out, to think through, again, risk levels throughout the organization within each of those key functional areas.
Okay. Any other trustee comments or questions? Would anyone like to formulate a proposal or a motion to accept these priorities?
So moved, Mr. Chair.
Thank you. That's a motion by trustee Linda. Do we have a second?
I'll second.
We have a second from trustee Abbott. Is there any public comment on this agenda item? There is none. Any further trustee comment or questions? Seeing none, we can vote. All in favor? All
Aye.
opposed? The internal audit plan is accepted. Great. Item 6.3, Governance Committee. Yes.
So
last
we
met
had it.
June 17?
Yeah.
Yes. Mhm.
We had a meeting yesterday. It was
Mhm.
quite a productive meeting. I would like to give a shout out to Amanda for her updates for the roadmap. As you know, for the governance roadmap, we have like 3 policies that we're going to review every quarter.
Mhm.
And as different priorities come up, or sometimes we're making some shifts to that. So we're having this very orderly procedure. So just as we had a shout out earlier about how we're taking a more proactive approach in terms of getting ahead of things, we're continuing to do that with our policies. So we actually reviewed policies on CIO and CEO performance. As our CEO had mentioned, we'll see that in August. Also in August, one of the things is we'll hear more about the AI, the current policy on AI, because that's one of the things I know that our trustee Chandra had brought up, and there's some other things that will come up. So we're continuing to keep abreast of the things that are really important. And then in Q4, we'll see actually we'll review the policies on the CEO, CIO, and board education policy. So we have sort of things that we'll see as a board in August, and then things in the next quarter we'll continue to see. So it's an ongoing process of policies.
All right.
Anyone from our committee want to say add anything else?
I think that was a good
summation. Okay. So that's it.
Great. No action is required. Are there any
No.
questions from trustees? Any public comment on this agenda item? No comment? Okay, thank you so much. Disability Committee also met in June, and Vice Chair Faulkner is chair of this Committee?
Correct. So we had a meeting last week. We heard one service-connected disability retirement request. That will come to the board in August. Other than that, we will see what comes our way for our August committee meeting.
Okay. Any trustee questions or comments? Again, no action required. Any public comment? No comments. Thank you very much. Joint Personnel Committee, our chair is currently absent, but we haven't met since April 1st, so I don't believe there's much to report there, and no action is required. I guess I need to permit any public comment on this item. There is none. Education and training, as usual, there's a plethora of self-improvement opportunities. Are there any proposed agenda items? Seeing none, this meeting is adjourned. Thank you all.
So enjoy your July
Recording
meetings.
stopped.